Welcome to the final lap. Yes, this is the last module that covers everything that you need to pass your ICAN Case Study exam. So in this particular module, I would be teaching you other aspects of case study, because all you need to pass is not just the financial analysis part or the basics or the starting point. It's far beyond that. Sometimes these little things that people ignore are actually very important. So in this particular module, I'm going to be breaking it down and explaining each of the things, all the things I need to know. For instance, ethics. When ethics is tested, ethics on its own is 10%, so that's like 10 marks. So it's actually very important. And make sure you share this video with anyone that you know benefits. Subscribe, and I'll see you in the next one. So ethics in ICAN Case Study, that's what we are actually looking at. So from the screen, you can see that 10% of your grades are awarded for identifying and properly using the ethical issues in the case study. And you have to understand that it's important to understand what ethics mean, how it works, and how to apply it to any case study question. So that is my goal for today. Now let's define ethics. Ethics are the values and principles that guide decision making. They are the values and the principles that guide decision making and behavior within an organization. So when you're talking about ethics, basically what you're talking about is those principles, those values that the organization is anchored on, those values that guide how we behave. We don't just behave anyhow. We don't just do anyhow here. We have guidelines, something like that. So that's what ethics is talking about. And in business, ethical standards are largely shaped by organizational structure and actions of the individuals. So in this case, when you're talking about a business situation, the standards that guide the way, or the morals, or let's just put it like this, the principles that guide their behavior are anchored, or they are shaped by the culture of the organization. Each organization has its own culture. Each organization has the way they behave. Each organization has its own different leader and people in leadership position, right? So that will now depend or determine the way they behave. And that's why we say that ethics are principles. It's not a rule based by fire by force. Everybody must do this. And yes, honestly, honesty, for instance, or integrity, everybody knows that. Well, everybody has to be honest, everybody has to be honest, everybody has to be of integrity and all of that. But everybody has like a right to choose how they want, and that's why we say ethics is principle based. Trust is a critical element of business ethics, because stakeholders rely on organizations to act responsibly, and once trust is lost, it's difficult to regain. So the reason why ethics is also very important is because ethics, when we know, let's even put ourselves in the shoes of an investor or a stakeholder or someone that has a stake in the business, right? So if you know that business A has good ethical morals, the organizational structure, the culture, the way they behave in an honest way, they have integrity there, they have like professional competence there, and company B doesn't have any of that, where will you want to drop your money? Let's be honest, you understand? So obviously company A. So ethics actually breeds trust in the hearts of the stakeholders or people around. So that's why it's very important. And ultimately, business ethics requires organizations to reorganize what is right and choose to act ethically. So they have to know what is right, they have to act in a good way. It's very important as well. So earlier I said that ethics is principle based, right? So the principle based approach to ethics. So the accountancy profession uses a principle based approach to ethics, meaning accountants can follow guiding principles rather than strict rules. So they are just principles. When you say something principle based versus rule based is saying if you don't do this thing, something will happen. Principle based is saying, well, these are the rules, the best thing for you to do is to obey them. So it's sort of like in a secondary school that they will say, oh, the rule here is you must wear your school uniform. If you don't wear your school uniform, you will not be allowed to attend classes. So that is like a rule based approach, and it comes with so many punishments or fines or something like that, you understand? But principle based may just be if you like, don't read your book. You understand? So it's your choice whether to read or not. But you know that if you don't read, you will definitely fail. If you read, you'll definitely pass the exam. So that's how principle based is. So principles based is basically saying that there's no strict rule attached to it, but the best thing for you to do is to obey. It's going to help you a lot. And the IESBA, the International Ethics Standard Board for Accountants, they're the ones that actually develop the standards that we use as accountants all over the world. And there are some certain rules, or I can't use the word rules, I'll say principles, right? Because that's the right word when we're talking about ethics for accountants, right? So these are the principles that we use as accountants. They were what's put together by the IESBA. And then the IESBA says that the professional accountants must act in public interest and not focus on what the clients or employers need. So when you're doing accounting, you have to act in the interest of the public. Think about the public, not your employer. And that's why you see people saying, I've had questions a lot from students doing case studies saying that if the company is doing, let's say they say something like the company is, let's say they are doing an unethical business practice like the one they gave in November 2025 diets, where they said that the company's regional managers were tampering with some parts of the cars that they were selling, because the company was into sales of cars. So in that case now, there was someone like, how will we call them out? Like, should we expose them? If you talk about the ethical issues there, but like exposing them and all. That's what IESB is saying. IESB is saying when you are pointing out ethical issues as an accountant, you're not thinking of your clients. And if it's an internal report, you're not thinking of your employer. You are like, this thing, I'll call it out. So it's more like self-righteousness in that way, that I have to expose evil deeds that will affect the general public. Fine, my employer may go to jail, my employer may be affected, but I do not care about that. My goal is for what? For the public to be safe. So that's why you see that we have to include ethical issues in our report, even though, yes, ideally, on looking at from one aspect, it's definitely affect our employers, right? So that's how it works. And it also provides a framework that requires accountants to identify threats, evaluate their impacts, and then what? So you identify the threats, you evaluate their impact, and apply safeguards to ensure that there's compliance. So in this case, now what you're doing is that the framework that IESBA gave us is a framework that can help us to see, okay, yes, this is a problem. And then, okay, what is the impact of that problem? Okay, this problem could lead to legal, because it could lead to, or could give legal issues or legal action or something like that. Or this threat could lead to poor reputation of the company. Customers might not like see them good anymore as good companies anymore. It may affect their reputation. You understand, something like that. Then also so safeguards. So it's not just, you're not just stopping at identifying the problem or seeing or evaluating the impact. You're also looking at the safeguards. Okay, now we have known that this company is into fraud, and we are seeing that fraud could give legal actions and it could damage the reputation of the company. Now, what is now the safeguard? What can they now do? Oh, they should stop the fraud, they should do this, they should do that. So it's a whole process. It's not just about identifying, but it's about also solving the problem. And then this means that if the accountant observes anything unethical, he's to mention it. That is why ethical issues are raised, whether it is internal or external. I've had a lot of students say that if I'm preparing an internal report, say I'm preparing a report for my company, am I supposed to expose my company? I just explained to you now that the public interest is what you are actually after. You're not after your employer, so, or your client or something like that. So whatever ethical issue is raised in the examination, you are to talk about it. And now there are 5 fundamental principles that the accountants must comply with. So these are the principles that were given by IESBA. We have integrity, that means you must act honestly, you must not give any misleading information. Objectivity, you must not be biased. Your decisions must not be influenced. You have to be objective. Then professional competence too. You have to maintain your skills, keep improving yourself, be competent at what you do. Confidentiality to protect your work, your clients. Not that you're gonna be sharing all the information outside without authority. That's wrong. Then professional behavior too. You should comply with the laws and maintain good reputation. So these are the principles as accountants we must follow, we must imbibe, we must make our own according to ISB. Now, the big question is, why are ethical issues part of the case study syllabus? Now, ethics is included in case study syllabus because as a professional accountant, you are expected to recognize and address ethical issues in real life work situations. So, in the real life work situations, I always tell my students that case study, unlike other courses like audits and all of that, case study prepares you for the real world. It prepares you because in the real world, your boss or your client will not ask you, please, can you define what is audit? Can you please define audit? Or can you please tell us about can you list and explain so they will not ask you that. They would have a problem most times and you have to tackle that problem. So that's why case study is preparing you for the real world situation or real world cases. So in this case now, ethics is included because most times in the real world situation, you also be faced with ethical problems. Your clients may have some dealings that are unethical. Your boss or your employer may also be dealing in things that are unethical. So in this case now, you have to know how to address it. So they are training you to address situations. So that's why it's in the syllabus. And ethical problems are often arise subtly and may not be immediately obvious. So it may be subtle. Like what that's just trying to say here is that it may not be obvious that, oh, this is an ethical issue. They might not spell it out that everybody, oh, this is an ethical issue or still. And there's some times that it will be obvious that you will know that, yes, this is definitely wrong. You understand? I'm going to look at some examples shortly. So it could be subtle, it could be obvious. You understand? So you have to still know how to do it. So ICAN trains you to identify those issues, and then you have to apply all those principles as well when making decisions. By testing ethics in ICAN Case Study, they prepare you to be sound, to exercise sound judgment and maintain public trust. So it's just basically preparing you. So yeah, I was my business with ethics. You're just preparing you. So it's a good thing, right? Now, ethical issues. This covers the application of ethical standards. Like, you understand? So in this case now, you're now applying those ethical standards that you have to the scenarios. And ethics is the principle of wrong and right, right? So, and it forms 10% of your grade. Yes. Ethics is 10. So if you have a situation whereby you have ethical issues and you don't list it, you have lost 10%. Yes. So according to ICAN Case Study, it forms 10%. So you have to ensure that you identify them well. All right. So in this case study examination, you have to identify the areas where the company failed to follow the moral principle. So what is the ethical issue? Okay, this is an ethical issue of maybe lack of independence. This is an ethical issue of conflict of interest. This is an ethical issue of maybe inappropriate pressure. They are just to provide a reported a result rather, or fraud or scam or something. So just identify the issue per se, and then state what the company should have done instead. Okay, let's say for instance, in I think November 2019, if I'm not mistaken, they were saying something like the company was trying to manipulate their products. They didn't want to label it. They didn't want their customers to know that they were locally produced. So now in that case now, what is the ethical issue? The ethical issue is misleading customers. That's unethical practice, unethical business practice. They were practicing something that was not unethical in their business by misleading the customers to believe that the products were not locally produced. So what should they have done instead? Instead, they should have said the truth. They should have let the customers know that they were locally produced. And if they know that they don't want to locally produce it, they should go to another country and actually do it and produce it in that country, right? Instead of lying. Then point out ways to eliminate them. That's you have the ethical issue is you showed or you misled your customers to think that the goods were not locally produced. What should you have done instead? You should have said the truth. Okay, now then point out ways to eliminate the issue. So in this case now, eliminating the issue means maybe withdrawing those products and labeling them correctly, or releasing a press statement to clear out all the problems or something like that. So that's how you treat ethical issues. So you talk about identify the problem, you state what they should have done instead, and what ways to eliminate that issue, or if something that they cannot eliminate, how can they reduce it instead, something like that. So now, how do you not determine if a decision is ethical or not? How do you determine it? So there's a 4-way test, and we have the four-way test, we have the publicity test that you can use to determine if this issue is ethical or not. Like, that's what I'm saying, that when you see an issue in your case study exam, how will you know that yes, this is an ethical issue? So the four-way test evaluates the decision, whether it is what's truthful, whether it's what's fair, promotes goodwill, and benefits all stakeholders. So those are the things they are looking at. Is it truthful? Is it fair? Does it promote goodwill? Does it benefit all stakeholders? So if an ethical, or let's say if a decision, if a decision is not truthful, like now that issue that I was raising earlier about them not telling their customers that they were actually locally producing, in that case now, that's lies, that's dishonesty. So that's an ethical issue. Then if it's fair, is it fair on the customers? Like, it's not fair. You're telling me that the goods were produced in the UK, and obviously that if I'm in Nigeria, for instance, and you're telling me that a particular product was produced in the UK, and I have another option which was produced in Nigeria, you definitely know that the one in the UK, because you're selling goods at a higher price to me. But that's not ethical. So when you see things like that, you definitely know that, oh yes, this is an ethical issue. So if these criteria are met, that means is ethical. That means what they're doing is ethical. Like, if it's truthful, if it's fair, if it's promoting goodwill, if it is benefiting the stakeholders, yes, you are moral, you are ethical. Well, if it is not, then that's an ethical issue. Some people used to confuse that thing. Oh, ethical issues. When you say something is an issue, is a problem. So ethical problem, think of it like that. So when we use the term ethical issue, I'm basically saying ethical problems. You understand? So ethical is good, ethical issue is not good, something like that. So think of it like that. Another way you can know if a decision is ethical is doing the publicity test. So the publicity test it considers the organization, whether the organization will be comfortable if the decision was publicly reported. So now in this case, if the decision was publicly reported, would they be okay, or are they reluctant to disclose it? Like, let this thing not be disclosed to our customers or to the public. Like the example I raised earlier, the example I used earlier, and the example of them wrongly labeling the products. They were saying that the products were not locally produced, meanwhile they were locally produced. Now in that case now, would the company want the world to know that it's a lie? It's one place in Asaba that they are producing this product. It's not New York at all, or New York. It's not in New York. It's Asaba. Would they want to know? Are they reluctant to disclose? Are they scared of letting people know this thing? Why are you scared? It's if they say run it where no man pursue it. I have heard they used to say it. So why are you scared? If you are scared, then there's something you are doing wrong. It's just like they'll say, if you are doing something bad, you do it in secret. So if I do something good, everybody should come and see, right? So now, if you are scared of it being publicly known or discovered or something like that, then that's an ethical issue, something like that. So those are the ways you know. And these things are not just things that will help you in your case study exam, but even in any reward situation you find yourself. And now, how do you not tackle it? So feasts is a way you can use to tackle it. Facts. Ask yourself, what is really happening? Okay, I'll still keep using the example of the locally produced goods that were wrongly labeled. So now in this case, what is really happening? Okay, the products were wrongly labeled. That's the issue. That's the fact. Now, who will be affected by this? The customers will be affected. The public will be affected. And the company itself can also be affected, because if it is discovered that you are giving false information about the location of where you produced, in that case now, if it is discovered, then people can take you to court. You can be sued. Legal actions can be raised and all of that. So, and your reputation as a company will be damaged. So it's not going to only affect the customers, but you as a company. Then now ask yourself, from that decision taking, what is the moral action here? The morally wrong action here. So the morally wrong action was what? You are doing unethical business practice, because in this case now, what you are doing is that you are wrongly labeling your goods. So you are engaging in unethical business practice, because as a business owner, you are supposed to practice honesty. You are supposed to practice there's a particular word I'm even trying to remember. They say that you can you can assess the channel of distribution or something like that, or channel of production or something, like transparency, sort of like that. So you have to let your customers know. Now that's why you see a product, you will see manufactured in China, produced, maybe distributed by so. You will see something like made in so. Sometimes they will list the manufacturing location, they will list the distributorship, they will list everything so that you can know how that product has moved. You understand? So in that case, now the morally wrong action here is that you are lying, you are not upholding good business practice. Solution now, okay, what should they have done? The alternative is that they should have actually been honest. Yes, they should have been honest. They should have said where the products were produced. And if they know that they don't want to produce locally, they don't want to be associated with a locally produced product, then they should go to another country and produce this. Now it's as simple as that, Abby. Then what? C is saying that what are the actions now? State the ethical issue and suggest the way to tackle it. So the ethical issue is now what? The issue of dishonesty, the issue of unethical business practice, of wrongly labeling the products. So what are the ways to tackle it? Oh, they should do this, they should be judged. So think of ways. So this FIST is a way. It's just an acronym I came up with, actually. You don't necessarily have to stick to it. I think from the explanations I've been giving so far, it's something that you already have an idea of and all of that. So understand. So that's how you can tackle the issue. So ask yourself what's happening, who will be affected, what is the wrong action here, what are the solutions they should have taken, and then what? Now, what should they do to actually tackle the issue on ground? Now, examiners, what do they look out for? I actually intentionally took a screenshot of the words of the study pack so that you will see exactly. It's not my words, it's the words of your examiner. In this case study examination, candidates are expected to develop answers based on the demonstration of professional skills. Tackling ethical issues is by its nature and an exercise of professional judgment. And now what are they saying here? Is your judgment that matters. Like for instance, now somebody can say that the way to tackle that issue is to withdraw the products that were wrongly labeled. Somebody else can say that, oh no, I think the best way to tackle the issue is to confess to the customers. Some people can say the best way to tackle the issue is to close down that product line, since it is. Yes, so it's, and three of them, are they making sense? Yes. If you withdraw the products, is it going to solve the issue? Yes. If you confess and release a press release or something like that about it, is it going to solve the issue? Yes. If you end that product line, since it's contaminated and filled with a lot of dishonesty, would it solve the problem? Yes. So three different people have thought from three different beautiful ideas, or different beautiful different beautiful ways. You understand? So the fact that I said they should withdraw the products and you said that they should release a press release doesn't mean that my own idea is better than yours or something like that, or your own idea doesn't make any sense. No, that's not the case. And that's why they said that it's a nature or exercise of it's an exercise of professional judgment. So it has to make sense. If somebody says keep on selling the products, this one does not make any sense. You understand? So it has to make sense, it has to be relevant, and it has to actually solve that problem. A candidate's consideration of and response to ethical issues within the case study examination would therefore normally be assessed mainly under the areas of how well the issue has been identified and explained, as well as how judgment has been applied. So they're going to assess you on how well have you identified the issue and explained it, and how has your judgment be applied. So the way you'll be assessed is that, okay, how do you identify the issue? Okay, so yes, this issue is an issue of unethical business practice because they are dishonest, they're not telling them the right place where they produce the product. So explain it well, identify it well. And they're saying that they're not saying you should write stories, just in few lines, not a whole textbook, please. And then how well have you apply the judgment. Like I said, now, even though the professional judgment is required, and that's like subjective to everybody, but it has to make sense. You cannot tell us that the company should keep selling the products. What do you mean? They should keep doing bad things, they should keep being immoral. You understand? So how well have you exercised your judgment? Did you give a good judgment that is going to solve the problem? You understand? And solve the problem in an ethical way. Because not that you will not give solution that is still unethical. No. Solution that will help them to maintain morality as a company. So that's how they're going to assess you. So if you give those things, they will give you good marks. Ethical considerations therefore form a significant part of the total marks available. As a result, a candidate who does not deal with ethical issues in the examination will seriously jeopardizing his or her chances of success in the examination. So if there's an ethical issue, like I said earlier, ethical issue is 10% of your grade. And you're saying 10% is 10 over 100, right? So that's 10 marks. So if you are going to, if they give you ethical issues and then you don't identify it, you have lost 10 marks like that. 10 marks is a lot. You understand? So please ensure that you do it in the examination. So possible ethical issues that can be found. So these things are always listed in your pristine. So I think the second page of your pristine is always there. So you don't need to cram it. You understand? So it's always there. The possible ethical issues that you may find. You can just check any pristine material, just open anyone, you'll see that it's always there. And the ethical issues will not normally form a specific requirement, but it will be within a requirement. So now you may not necessarily have like requirements for is ethical issue, is a requirement on ethical issues. No, most times you would have it within a requirement. So they could say something like evaluate the financial statement of XYZ Limited and identify potential ethical issues, something like that. So they will add it to a requirement. And now the ethical issues may cover issues like lack of professional independence or objectivity, conflict of interest. So in this case, now they're saying that they could give you a situation whereby the company does not have professional independence. And of course, if the company doesn't have like professional independence, like they don't have independence, there's no independence. Let's say the head of the board of directors is also the head of the management team. You know, the reason why we have a separate team for the board members and a separate team for the management members is basically for check and balances. You understand? Checks and balances. So we have to more like we are monitoring each other. We're trying to like sort of like separation of power. You understand? So, but then if the powerhouse or the head of the one at the head or position of power in the board team, on the board team rather, is also the one that is the head on the management team, then who would check and balance who would? I'm the guy everywhere now. I can commit fraud anywhere. Nobody will hold me. Nobody's going to call me into order. Do you understand? So if a company like that, like you have like, there's no independence, there's no external independent or non-independent executive or something like that. You understand? If it's an independent if there's no independent director, yes, that's the word. If there's no independent director, everybody or our family members, who would expose who? Is it my sister that wants to expose me, or my brother that wants to expose me that I'm doing fraud? Or let's go back to that example that we used, the example of labeling the products wrongly. So if it's me and my sister that were in the business together, is it my sister that wants to expose me that everybody come and see my brother? You cannot expose me. We enter the family house and we'll settle the matter there and close our mouth and come back outside. You understand? So if it's composed by members and there's no independent party, for instance, if it's me and my sister now and we have maybe an external person that's not a family member, there's still a lot of security in that sense, because the external person can expose us. It's not part of our family. He does not have anything to lose. It's not going to be cut off from any family. It's not part of our family, right? So if the company doesn't have that, there's a problem, because every company should have an independent director so that anything, the person can always like be objective about his decisions. And you know, that can also lead to conflict of interest as well. And doubtful accounting or commercial practice. So in this case, that's for accounting too, you understand, or creative accounting in that case now. So in this case, then it could be that maybe they are creating a situation whereby you know that this their account is not they are doubting it. Last year they said that they made profits of 100,000 naira, and this year they are making profit of 200 million, like from 100k to 200 million, like, and there's no evidence of maybe something happened miraculously that could, because it's true, it's possible for a company to be making 100k this year and next year they actually made 200k. It's possible. It's very, very possible, because if for instance, and let's say they expand their operations or they got a big business contract or something like that, so it's possible. It's not impossible for that to happen. But if nothing like that happened, like you did not get any business contract, you did not expand, nothing, and just move from 100k to 200 million, how far? So that's like doubtful accounting. So in that case, now you know that there is something going on, maybe money laundering or something, because that's the only explanation. How did you people get that kind of money? You understand? There's no explanation to it. So in that case, like I can say, the accounting here is, or the account that was provided poses an ethical problem of maybe creative accounting or something like that, or manipulation. You understand? There's a possible manipulation. You can say there's a the fact that the profits increased from 100,000 naira to 200 million naira without any concrete evidence. This shows that there has been a possible manipulation in the financial records. You understand? Something like that. You understand? And feast. The fact is that what the figure jumped from where to where. You understand? And you know that we said our E2 is that who will be affected in this case now. The shareholders may be affected because now the shareholder may just say, wow, this company made 200 million, let me invest my money. Meanwhile, it's the fraudulent company. And what is the morally wrong action here? No evidence, no nothing. You just jump. You're supposed to tell us now how far. You understand? What should they have done? They should have what? Yes, it's possible that legally they could have increased in profit and all of that, but they should have disclosed. That is the solution they should have taken. And now, what is the action they should take? The action is that they should what? Disclose how they got that money. And if it is through any fraudulent means, like money laundering, for instance, they should what? Desist from it. They should run away from it because it can lead to legal actions and also damage their reputation. So an inappropriate pressure to achieve a reported result. I think this was similar to what they did in November 2025 diet. In that case, now they said that the managers, they were giving bonuses for achieving a particular result, and because of that, we're now like manipulating the cars, like because the company was into sales of cars, so they were tampering with the cars. You understand? So because they wanted to achieve that result and get the bonuses. So in that case now, that's an ethical issue of inappropriate pressure to achieve a reported result. So if you are saying that there are something's happening in the company and then they're doing some unethical things just to achieve a result, then you know that that's an ethical issue. Then unethical business or commercial practice as well. So in this case, just like the example I used of the wrongly labeled products, that's an unethical business practice, because the practice of business is that a good business is supposed to be transparent about their supply chain, transparent about how it moved from manufacturing to distribution to whatever. You understand? Marketing should tell us. We should be able to know, why are you closing it, why are you lying to us. You understand? So all these things, so there are possible ethical issues that could be inserted within the question for you to see. And like I said earlier, sometimes it's obvious, sometimes it's not obvious, so just be careful about it. And how to include it in your report. So the issues are embedded in the case study are a component of the examination requirement. So like I said, it should be part of the requirement, but they will not normally form a single requirement, just like I explained. They are usually, but not necessarily, but not necessarily form a part of a requirement, which typically asks the candidates to discuss the company's operations or strategy, but can occur anywhere in this scenario. So what I'm just basically saying is that it should not be a requirement. So you cannot see something like requirement 4 is an ethical issue. No, they'll insert it, just like I said, the example I used earlier, that they can say evaluate the financial statement of XYZ Limited and identify the ethical issue. So in that case now, that's one requirement, but it has 1A and 1B. So you have to be careful about those kind of requirements as well, because now the 1A is what evaluate the financial statements. The 1B is what identify the ethical issue. So most times it will be part of a requirement. So always look out for it. And just like professional skepticism, I said, you have to embed it into your report. So you put it inside your report. So it could be a paragraph in your report. You understand? For instance, now let's say it's part of requirement 1. So after talking about, let's say you use ratio analysis, for instance, to evaluate the company's financial statements now. So after talking about all the whole ratios, you can add a paragraph that will talk about ethical issues. So you can even have a heading, ethical issues, underline it, and have a paragraph, but to be part of the body of requirement 1. So the conclusion and recommendation for requirement 1 to be part of the conclusion and recommendation for requirement 1, because requirement 1 is 1A and 1B. So all the 1A and 1B, 1C, 1D, whatever, all the whole thing about requirement 1 will be under the body of requirement 1. So don't go and put it under another section or something like that. No, add it inside according to what they say. And like I said, just like I said there, it is part of the body of that requirement. So examples now. Let's look at examples of ethical issues in the report. So the pressure to present an attractive financial statement made ABC Limited manipulate their financial position and thereby publishing false statements. This goes against the principle of what integrity. So in this case now, I'm just giving examples of situations. So if they could tell you that ABC Limited tried to manipulate their financial records because they wanted to publish a particular result. So let's say they told their stakeholders or their shareholders, don't worry, shareholders, we are going to increase our profits next year by 10%, and profit has not even increased by 2%, and the year end is drawing close. So they quickly manipulate everything just so that 10% can be achieved, and so that their stakeholders can praise them and still like, oh wow, you did what you said. So in that case now, that's another one is doubtful accounting practice. That's manipulation of the financial statements, right? Another one they could give again is that the financial information of Skyrim and Co was leaked to unauthorized parties. This goes against the principle of confidentiality. So they could tell you that the manager actually sent the financial information or leaked a financial information to an unauthorized party. In that case, now you know that that's going against principle of confidentiality. And don't forget that one of the principles that IESBA gave was that as accountant we must practice confidentiality. So that kind of stuff, sack letter straight, sack letter straight. So I'm just trying to give you examples. So points to note that you have to take note of. Some ethical issues are obvious, while some are subtle. Like not everything will be obvious. For example, the examiner can clearly state that the company manipulated their financial records, or they can give you a board and management team with no independence. So now in this case, now they can clearly tell you that candidate the financial records of the company was manipulated by the managers. They can clearly state it there. An example was November 2025 diet. You can check that out when you are free. They clearly told us that the managers manipulated the odometer readings. That's they tampered with the cars. Another one again was the one that I'll show you very soon. I think I can almost quickly show you now. We'll go back to it. We'll go back to the others later. So I think it was May 2025 diet. So if you look at May 2025 diet now, you'll see that the board and the management team. You see that Chief Adeolu was the chairman. Fine. Titi was the managing director of the board. Titi is also the managing director of the management. Andrew is the let's see. Andrew is the technical director of the board. Andrew is also the technical director of the management. Tafa is the finance director of the board. Tafa is also the finance director of the management. Dorcas is the marketing director of the board. She's also the marketing director of the management. So the only difference is Abraham and Tolu, which were not on the board, and the chairman too was not on the management team. So that means 4 out of the 6 board members were part of the management. How would they be independence? How would they be objectivity? And again, apart from that, they are not just on the board and the management team. They are holding significant positions. So if we have the managing director, the technical director, the finance director, the marketing director, we have them to control. the company cannot be fraud, scam, everything will just be going around because the company cannot be ethical. You understand? There's high chance of unethical practices being swept under the carpet because not only are they on the board and the management team, fine, they can even be there, but they're holding significant positions. So in this case now, this is an ethical issue. So the company might not, I'm just saying that ethical issues might not be obvious, but they can just give you something like this and then you know that no, this is an ethical issue. So let's go back to what we were doing earlier. All right, so this is where we were. So that's about point 1. Then point 2, the analysis of an identification of ethical issues to be included in an answer should only be done when it's relevant to the requirement. So anytime it is relevant to the requirement, that is when you should talk about ethical issue. Only analyze ethical issues if the examination question asks for it or if it is relevant. So if the examination question is silent, if they don't say anything about ethical issues, please don't talk about it. Let me repeat that again. If no information was stated about any ethical issue, ignore it. Don't include it in your report. Yes, ethical issue is 10% of your grades. And earlier we saw in the study pack that if you don't include it, you are jeopardizing your score and all of that. We saw that. But the examiners, this point I'm noting is not my point though. Is an extract from the examination study pack. You understand? You can go and check it yourself. Go and check the case study examination pack on ethics. You will see that it's there. You understand? So if it is not included, if they did not talk about anything and it's not relevant, nothing about it was said, and no board management team, there was no ethical issue, leave it. The examiners know what they are doing. 10% is awarded for ethical issues. If they are not asking for ethical issues in that particular exam, that 10% they will add it to other places. So don't go and develop ethical issues that are not there. For instance, the board management team, there's independence. Like there's no board member on the management team. You're not gonna lie that there's lack of independence. Can't you see that there's no board member on the management team? Why are you not saying that there's lack of independence? Of course, there's independence in that case now. So don't go and form any ethical issue by yourself. Or they don't say anything about the company labeling products falsely. You don't go and put it there that the company is, why now? Did they tell you anything like that? No. So don't form any question. That in that case now, you have deviated from the examination question because the examiner did not tell you anything about false labeling of products. So you have set your own, you have become an ICAN examiner by yourself. So please don't do that. Focus on the requirement, stick to the requirement, and do only what is in the requirement. If the ethical issue is there and you don't raise it, you will lose 10 marks. If the ethical issue is not there, don't raise it. The 10 marks will be added to other places. They know what they are doing. Please don't do that. Now, use professional judgment. And remember that ethical issues often have shades of grey. There's no right or wrong. And shades of grey basically saying that you may see it as 6, me I may see it as 9. Just like the example I used earlier, that somebody can say withdraw the products, another person can say put up a press release, another person can say end the product line. You understand? So now different areas, but they are all making sense. You understand? So there's no perfect right or wrong answer. There's no like your own is better than my own. But let's balance it. Yes, there's no perfect right or wrong answer. Quite all right. But there are some answers that are wrong, yo. You're not saying they should keep selling the products. That one is wrong now. They say the product is falsely labeled. They are misleading their customers. You're not saying they should keep selling the products. That one is wrong on all levels. So fine. Yes, there are different areas that people can come in that will make sense, but there are some that will not make sense. So please be careful. Look at the situation carefully and apply your professional judgment. What you think is morally wrong could be viewed by another person, and they will argue that it's acceptable. So in that case now, just ensure that you are using your professional judgment well and you are answering the question properly. So now, practice questions. Let's look at some cases when the issue is obvious and when it is not obvious, like ethical issue. So in this case now, the 2019 I actually included it here, where they were talking about the company being labeling the products wrongly. So this was the requirement. I actually included the requirements because I wanted you to see something. This was the requirement. So in the requirements, if you look at the requirements very, very well, you will see that they said something here. They said that they should assess the contract supply service and all of that. And they said something afterwards. And discuss the commercial and ethical considerations as well as the risk. So this is 2A. This is 2A. And this is 2B. So it's like 2A and 2B. Do you understand? So in this requirement was one requirement, but it had 2 legs, 2A and 2B. So this is what I mean by ethical issues will be included in between the requirement or inside the requirement. It's not going to form a specific requirement. So they're not going to say ethical issues requirement 3. No, it's still under requirement 2. You understand? It's not going to form a specific requirement. That's what they mean by this. It will be part of a requirement. Like this now. They are saying that after talking about the contract supply, you should also want to talk about the ethical issues. And if you look at the contract supply now, let's go and look at it now. You can see that this was the requirement. You can see it here where they said that what Detoy Farms, this is number 3, Detoy Farms will not label the packages as the shop will label the packages itself. This is because the shop does not want the customers to know that the products are locally produced. You understand? So that was the issue in that case. And I also included the second exhibit because you can see that this is exhibit 10. Okay, I didn't even screenshot that part. This was exhibit 10. I also included exhibit 11 because there was an ethical issue there as well. So if you read all this now, you say that what Detoy Farms will repackage all returned vegetables and meats from the shop and resell them and sell them to regular customers as fresh farm products. So returned vegetables, is it fresh? No, it's not fresh. So think of it like this. I bought carrots from you from the shop, and maybe the carrots were not what I wanted. Or maybe I mistakenly picked 2 carrots instead of 3 carrots, and I returned it back to you. Or let's say I said I don't like the carrots. I went to the shop and returned it. Detoy Farms will not come and collect all those returned products and put it on their own shelf and say, fresh products. Is it fresh? It's not fresh, and it has been sold, it has stayed long and all of that. So in that case, and this is also an ethical issue. So in this particular November 2019 diary, there were 2 things: the locally produced goods that were wrongly labeled, and the fact that they were selling not fresh product, unfresh as fresh. If that makes sense. And I had to include it in your report. So this is the paragraph. So you know that after we talk about the contract supply service, which was in exhibit 10 and exhibit 11, then what? We'll not talk about, so we're finished talking about that up. We'll not create a paragraph still under that same body of requirements too. We'll not create a paragraph. We'll say ethical issue. Can even label it ethical issues. The contract made by Detoy Farms with the shop contains some ethical issues. That's the contract, right? One of which is the decision not to label the products because the shop does not want its customers to know they were locally produced. And the second one is the repackaging of returned vegetables and meats to resell as fresh farm produce to Detoy's regular customers. This is an ethical issue of unethical business practice, and it should be reconsidered to avoid legal consequences or reputation damage. So you see that we talked about the feast. What was the fact here? The fact was that they were not talking about, they were repackaging the returned vegetables and they were not labeling the products very, very well. Who was it going to affect? Because it was going to affect the customers, right? And again, the A was I think let's go back to it. I think yes, the A was wrong, morally wrong action here. We have talked about that. Then the solution and the actions they should have taken too. So in this case now, what were we saying now? This is an unethical issue of unethical business practice. And then it should be reconsidered. They should stop doing it. That's what they should do. And what are the steps to take? They should stop doing it to avoid legal or reputation damage. See, most of the time, the solution to ethical issues or the consequence of ethical issues is basically legal consequences or reputation damage. So that's something you can use very well. So let's look at another example. November 2025 diet. I also mentioned this earlier. So you can see that this was the requirement 1. And they said that we should evaluate the financial statement whilst identifying and addressing any potential unethical practice. So you can see that this is requirement 1A and this is requirement 1B. So it was 1 requirement but 2 things. So please, whenever you are reading your requirement, try to check, because now if you only answered the question of evaluating the financial statement and you didn't talk about the ethical practices, you will lose 10 marks. 10 whole marks, like 10. Just because you did not read your requirements very well and you answered only part A, you didn't answer part B. So please always read your requirements very well and always ensure that you answer everything. And what was the ethical issue? So I took a screenshot of that as well. So you can see that I actually mentioned it before. They were saying that the regional managers were practicing the tampering of the odometer readings on the imported vehicles. And why were they doing this? The action was primarily motivated by the bonus system in place, which directly rewarded the managers for achievement of volume targets. So in this case now, they had a particular result they wanted to achieve, and because of that, they were manipulating the figures. So in this case now, this was inappropriate pressure to achieve a reported result. So that was what made them to manipulate everything. So that's, in that case now, was the issue. So You can actually include it like this: the tampering of the odometer readings on reported vehicles held in inventory by the regional managers is an ethical issue of what inappropriate pressure. And if you notice something, the first one I said that it was what an unethical issue of it was an ethical issue rather. It was an ethical issue of what unethical business practice. This one I said it was what an ethical issue of what inappropriate pressure to achieve a reported result. And guess what? Remember that list I told you that will always be in your case study exam, your prison. You can see that that was where I got the figures from. I did not have to disturb myself or cram anything. I just went to check the lists in the prison and I got the information I needed to answer the question. So the expo is there actually. So just read it. And this can also be an unethical business practice because you are not doing well. In that case, you are falsifying your results. So by engaging in this act, FOLAC has breached the regulatory practices and undermined the trust. So I have talked about the facts. The fact is that what they were tampering with the odometer readings, right? I've also talked about the facts. I talked about the E. So don't forget, always this fist is always going to help you. You understand? So something you can use. The facts, who is going to be affected, the customers, who was the morally wrong action here. The morally wrong action is that what they had inappropriate pressure to achieve a reported results and what unethical business practice. Then now the S and the T. Let's go and look at it now. The solution and the actions they should take now. By engaging in this act, they have breached the regulatory practices and undermined business trust or customer trust. This can result in what damaged reputation. You know, I said it's legal actions. Those two things, the things I can always use because ethical issues will definitely lead to those two. And then the practical steps. That's the tackle. How can they tackle it? The T. They should address this issue. And what bonus system, which is the motivation. They should remove the bonus system. At least if there's no bonus, they will not be motivated to do evil anymore. So this would just be a paragraph under the body of requirement 1 because it's requirement 1B, kind of something like that. Then the one that was like subtle ethical issues, the non-obvious ones, I actually talked about it earlier, but I'll just briefly look at it again. That was the 2025 one where I talked about the fact that the board members were on the management team, and not only were they on the management team, majority of them were on the management team, number 1. Number 2, they were holding significant positions on both teams, so that was not good at all. So this is a subtle ethical issue of what lack of independence and possible conflict of interest. So you can say it like this. So I'll just include it as a paragraph anywhere in my report. It could be under 9. This one now, they didn't put it under any requirement A. It was a non-obvious ethical issue. So it was not under any requirement A or requirement B. So in this case now, I can just put it under any requirement. I can decide to put it as a paragraph under requirement 1. I can decide to put it as a paragraph under requirement 2. It doesn't matter because now I'm not tied to a particular requirement. It was not added to a particular requirement. Do you understand? So I have put it like this: the position of the board indicates lack of independence and possible conflict of interest, which will result in ethical issues. 4 of the 6 members of the board members were on the management team. It is highly advised that DEFCON considers a reshuffling and an independent director can be appointed to oversee activities. So you can see that even though this was not in the requirements, it was not obvious, but it was given. So please and please, if nothing like this was given and they did not say anything in the requirements, don't form a question by yourself. Ignore it. Don't form a question by yourself. Only include ethical issues when you know that it is relevant to the question, relevant to the requirements, or relevant to that case study. So this is all about ethical issues. If you haven't subscribed, why? Hit the subscribe button now. And if you have not shared, why? Share as well. And just say something about ethical issues. Which of the ethical issues do you think you just resonates with you that wow? and what do you think about the locally produced goods that were falsely labeled? I want to actually hear your thoughts. Like let's imagine that you are a boss and you are in that situation that you're a customer, rather. Let's put it on the side of the customer. You're a customer, you find out that the products that have been buying from the UK or thinking it was produced in the UK was actually produced in Asaba, how would you feel about it? And would you actually want to take legal actions against such a company? Well, I want to hear your thoughts in the comment section. Let me see what you think about it. And I will see you in my next video. So today we're talking about sustainability. Sustainability was a major thing that was added to the new syllabus actually. Although other things were added, but when the study packs were released, the major additions to the study pack was on sustainability. That was chapter 3 and chapter 8. So I summarized those chapters and I created this document. So this class on sustainability will be divided into two sections. So in this particular section, we'll be looking at the introductory aspects, and the second video, I'll be showing you how to analyze and interpret sustainability reports. So the first thing I want to even say before we even start is that a lot of people think that sustainability is just about the environment, but it's way beyond that. And today I'll be showing you other aspects that probably you haven't thought about before. If you have not subscribed, please hit the subscribe button and share this video with anyone you know benefits from it. So now let's look at this document. What is sustainability? Sustainability means protecting our environment and creating a safe world for people today and in the future. So in this case now, just like I said, yes, you are right. If you were part of those people that thought that sustainability was majorly about the environment and protecting it and all of that, yes. But then look at the next thing. It is not just about the environment. It covers people, it covers the planet and prosperity. So these are the three things that sustainability covers. It's not just talking about the environment alone. Yes, the environment is a section of what sustainability entails, but it also covers people, and it also covers what prosperity, which is peace and economic growth. So what's that talking about now? Let's look at those three things so that you can understand better. Now, there are three pillars of sustainability. Think of it like a table with three legs. You know, if one leg is not there, the table will collapse. If you put something heavy on the table, everything will just fall off, right? So these are like the three pillars as well. Like the three legs of sustainability, they all work together. Everything has to be in order. Now, I'm using the illustration of a table so that you can relate to what I'm saying. So please follow me closely. Now, the first thing is people. People, what is people talking about? People is talking about social equity. And this aspect of sustainability is saying that we want to end poverty, hunger, improving health, education quality. So sustainability, when we say we are protecting our environment, when we say we are creating a safe space for the current generation and the future generations, when we say we're doing that, what we're talking about is that we are ending poverty. Like when we talk about people now, we're saying okay, for there to be a world that is safe and peaceful, we have to ensure that hunger is like not existing anymore. We have to ensure that poverty ends. We have to ensure that education is, let's call it education and all of that, you get. Then another aspect is saying that that is now the environmental protection. Okay, if we are saying that we are really protecting people, we're ending hunger, we are ensuring equality, we are ensuring hunger ends. But then the place where the people that are not hungry will stay, uncle. You understand? So we have to also protect our environment. And how do we do that? We fight climate change. You know, the ozone layer is depleting, all of that. You understand? We protect our water, we protect our land, we protect our ocean. Now, apart from that too, we also have to look at our economy. We also actually have to see how we can ensure that there are jobs, ensure there's growth, there's innovation, there's partnership, and economy is saying that we should live in peace and prosperity. Understand? So now these three things, what is it now? Let's now put it all together. So now what it means is that for us to have a safe world for the current generation and future generations, we have to ensure that the people living in the world, they are fine. That's in terms of no poverty, no hunger, or there's quality education. We also have to ensure that the planet, that's our environment now, is protected. because those people have to live somewhere, right? And then we have to ensure that what the economy is prospering, is prosperous. You understand? It's prosperous. You understand? It's prosperous rather. You understand? So those are the three things that we have to put together. Now, I know that there's a question that pop up in your head right now, and you'll be like, we're doing case study now. What's our business with sustainability? Yes, it's your business because you are actually writing ICAN. Why are you writing ICAN? You want to be a professional accountant, you want to be a chartered accountant, right? So these are issues that are facing the world today. These are issues that a lot of people are trying to look into sustainability. So you have to know it, you have to be aware. You understand? You're not just an accountant that will just be saying, oh, revenue minus cost equals to gross profit. No, you also have to be aware of these issues. And now, in case study, you are going to be analyzing the financial information of a company and also the non-financial information of the company as well. Now, companies are now producing sustainability reports. You understand? So if they give you a case study and they're asking you to assess a company, they may probably give you the sustainability reports to assess. So you have to be aware of all these things. So don't say, no, I beg, it's not a business. Let me just go and do ratios. You have to be aware of these things. Now, let's look at the SDG goals quickly. And the SDG goals are 17 goals that were created by the UN in 2015 with the hope that by 2030 we would achieve it. That's 5 years away. Let's see how it goes. And then these are goals that they are saying, okay, like I said, sustainable development goals, like they are global goals, like everybody around the world. Let's try to put our hands together to ensure that we achieve this. And now they said that what achieving SDG requires both the public sector and the private sector. You understand? So now, as a chartered accountant, when you get your certificate, you would work in the public sector or the private sector. So if you don't know anything about sustainability, then that will not be good. You understand? So you have to know it. Then governments are the ones that will set the laws and fund the projects. Then the businesses are the ones that will adopt those practices, right? And invest in sustainable projects. So in your case study examination, they could tell you that, okay, this company wants to invest in this sustainable this project that would protect the environment. Okay, help us to assess it. Is this project viable? Is it not viable? Is it good? Is it not good? And again, they may give you a project, and then the project would harm the environment. You have to tell the company, yes, so financial aspect good, MPV is positive, but you see this project you cannot embark on it because of what? Because it's going to affect the environment. You cannot tell them that, okay, the only way that this project can be embarked on is if measures are put in place to ensure that these challenges that could affect the environment are dealt with. Something like that. I'm just trying to give you a scenario that may, because I'm relating to case study. Let's not walk far away and forget where we're coming from. You understand? So what I did now is you can see that there are 17 goals. So I categorized them under the 3 pillars. You understand? Under the 3 pillars: clean water, no poverty, no hunger, and all of that. So that's just by the way. Let's not go deep into that because we are doing case study, right? All right. So now, sustainable business. Now, what is a sustainable business? I want us to look at this very well. Now, what is a sustainable business? Now, pay attention to this place. Now, a sustainable business is a business that considers sustainability. You understand? It considers sustainability. Now, you can see that a business is considered sustainable when it goes beyond profit. Now, in this case, now we're not just concerned about, oh, this project, does it have a positive MPV? This project, it's going to give me a payback period that I want, or something like that. Previously, that was a concern. Now, if you notice from previous diets, if you look at past questions, you see that the question will always say use MPV or use contribution analysis or something like that. You understand? That was the focus. But now we are going a step beyond that. You understand? Fine, yes. It's not like really sustainability we are going to be concerned about. We are a business. We want to be profitable. But the first thing is, okay, this business or this project, is it profitable? Okay, yes, it's profitable. The next step is that, okay, now, does it affect the environment positively or negatively? The people around, is it going to end hunger? Is it going to end poverty? Is it going to impact lives? Now, that is the full focus. Don't forget the illustration of the table that I told you. If one leg is missing, everything crashes. You understand? Everything will crash down. So everything is very important. So companies like this, companies that are concerned about sustainability, they usually have stronger reputations. Investors are usually interested in investing in those kind of companies. And then legal issues, they barely have legal issues, except other things, you understand? But legal issues concerning sustainability and environment protection and all that, they would avoid it. So these are things that you can also say. You understand that, oh, when if they give you a case study and then they're telling you that the company wants to consider sustainability or something like that, you can say, oh yes, this is good, and in addition, this would strengthen the reputation of the company. This would help the company avoid litigation, possible litigations concerning the environment. So I'm just trying to wrap your head around possible things so that you can know what to do. Now let's look at triple bottom line. Now triple bottom line. Now, don't forget the three pillars. I said something, and recall that the three pillars of sustainability are what? People, planet, and prosperity. Now, the triple bottom line is saying that what? It is the two companies use internally. The two companies use internally to measure and report their what? Their performance in these three areas. They use it to measure and report their performance. So I use the word internally. Now, I want you to liken triple bottom line, liken it with management accounts. Yes, you know, the management account of a company is an account that is used by the management. Yeah, management account is used by the management, but that's just simple thing. Let's not complicate anything. So that same way, so triple bottom line is the two, like for instance, when companies want to like create sort of like a management account, okay, like a sustainability report that we are going to use only for ourselves, a sustainability report that is just for the consumption of the management, the board of directors, or something like that, then we'll use triple bottom line. We'll use it to measure and report on our performance concerning people, concerning the planet, concerning the prosperity. That's the economy. You understand? Like I said now, the tool used by companies to determine the impact of their operations on the environment, their financial results, and how well they treat their employees, their customers, their community. You know, this is people, planet, and profit, basically. Now, the good thing, or should I say bad thing, depends on the situation actually, is that the triple bottom line is not bound by international rules. So there's no rule that is binding this. It's just, as I say, liking it to what? Liking it to management accounts. Management account is coming to fight you that, why did you put 15 naira here? Nobody's fighting you because it's internal. In fact, it's like confidential information in the first place anyway. So nobody is fighting you that this use this rule or use this regulation. No. And now I gave some examples. So profits, you can say, okay, the company profitable. You can check what's their revenue, what's their profits, what's their shareholder value. In terms of people, are they check it? Okay, what's the employee welfare? Are they good to their employees? Are they paying fairly? You understand? Are they satisfying their customers? Look at the planet soon. Oh, what is the emission? Like emission, I think of emission like like a factory that is emitting monoxide or emitting smoke. Let's use a simple word. Emitting smoke into the atmosphere. Okay, how much are they emitting? Are they emitting too much? Are they emitting too little? So what is their waste pollution? So these are the things that the company would consider when actually assessing. But the truth of the matter is, the one limitation of sustainability is that it's subjective, yes, and it's not really like, let me not say it's not really accurate in that way, because how will you say you want to measure waste pollution or you want to measure employee welfare? Is it that, how many times my employees smile or how many times were they happy? I don't really know. So it's like there are lots of subjective like things around it. That's just by the way. Now the advantages of triple bottom line is that it provides a complete picture of the company's performance, not only considering profits but also considering the social and environmental impacts. That's clear, right? However, applying triple bottom line comes to challenges, like I said, difficulty and costs of collecting reliable non-financial data, you understand? And like I said, the measurement is what is subjective. You understand? So there's a lot of challenge that is around that, and the fact that it's not even like bound by strict rules and regulations, so everybody can do what they like. So let's just say any sustainability report that is prepared by using triple bottom line like approach, that one is not reliable. So triple bottom line is like an approach, a tool, a method. When you think of method, think of like, for instance, now for financial statement analysis, now we'll say methodologies we can use are ratio analysis or trend analysis. So think of that, think of it like that. That triple bottom line is a tool that is used to assess the sustainability report. So when a sustainability report is assessed using triple bottom line, even if they say it's this case study report, just know that professional skepticism, you must mention it there. You will question the reliability and accuracy of that data, you understand, because there's high tendency that data that they're providing, that information they're providing, or that report would not be accurate, because there's no strict rule, it's subjective, there are a lot of comma there, you understand. So now let's look at sustainability reporting or ESG reporting. Now, ESG reporting, that's ESG means environment, social, and governance, or something. I think environmental or environment, something like that. Social and governance. So now, sustainability reporting, this is another tool. Now, it is a formal reporting system used by companies when they want to publish their performance. You understand? So in this case now, if it's a situation whereby we have to publish our performance, probably we have investors that want to see, or we have shareholders that want to see, or the public is concerned about our sustainability matters or something like that, then we cannot use triple bottom line. Like I said, even if we use triple bottom line, everybody would raise the professional skepticism because the accuracy and reliability of that data is just like low. You understand? So when it's internal, when we want to just use it for ourselves, we can do triple bottom line. But you see, when it's now a situation that requires taking that report outside the four walls of our company, then we have to use ESG reporting. ESG reporting or sustainability reporting is a formal reporting system that we use when we want to publish our performance on those three pillars. And then it makes use of international standards. Yes, international standards. In FR, financial reporting and corporate reporting, you have your IFRS, you have your IAS and all of that. So in this case now, yes, we have standards as well. We have the GRI, the global reporting standards, we have the international sustainability standard, the board is the ones that actually creates those standards. We're going to look at all those very soon, the IFRS S1 and S2. We'll look at that very soon, but let's take it step by step. And the reason why I'm breaking this video down and taking it step by step is because I know that as a case study student, you're used to calculations. So when is that theory, I can, what's this? You understand? And the fact that in the textbook is like over 30 something pages in one chapter, almost 10 pages, is a lot. So that's why I'm taking my steps to break it down, or my time rather, to break it down so that you can understand. All right, and that thing again is that the report is usually structured and verified. So it's not like triple bottom line where whatever we like we'll do. No international law or strict rules is binding us. No, in this case, we are bound by some rules. It's verified. We have to look for an independent external party, that's an external auditor, to come and check it, to verify what we have done. There is a structure that everybody must follow. It's just like IAS1. IAS1 will say when you are doing your income statement, start from revenue. After your revenue, go to cost of sales. After your cost of sales, move to gross profit. That's a structure, that's a standard. And the good thing about it is that it aids comparability. Do you understand? It is comparability. So because when everybody is using a particular thing, we can easily compare. But if everybody is using triple bottom line, how would we compare? This one is doing this one, that one is doing this one. Who are we going to say is better than who? Do you understand? But when we are doing sustainability reporting, everybody is using the same thing, so we can easily compare. Now it's usually prepared for outsiders. Like I said, we're publishing it, so it's definitely going outside. But there are some challenges as well. It's not like, all the glitters is not good. They also have some things. In Nigeria, the challenges include voluntary adoption. Not everybody is willing to adopt it. Not everybody has adopted it yet. There's low understanding. So people don't understand how to, what are we doing now? Or we say I should be measuring waste, pollution, measuring emissions. So there's a lot of understanding. People don't really understand what it's about. Then unreliable data, insufficient expertise, high costs and corruption, limited technological support, so many challenges as well. But at least the fact that there's even a standard, a structure is better than triple bottom line in every way. So I created a table where I actually gave like the differences between the two. You can see that triple bottom line is internal, this one is external. This one is used by management and employees, this one is used by external parties, this one is not bound by strict international standard, this one is guided by class standards, and this one focuses on the impacts of business on people. So how is the business, how is our operation affecting our employees, the people, affecting the community, the people? How is our operation affecting the planet, the environment? Are we causing pollution? Are we causing air pollution, water pollution? What are we doing? How is our activity affecting like our profits? So that's what triple bottom line is talking about. But you see, the sustainability reporting system is talking about how in this environment, social and governance, how it affects the finances. So now in this case, now we're looking at how the environment is affecting our finances. Okay, is it that because everywhere is polluted, we're not doing well? For instance, now let's look at the water company. Okay, let's look at probably Seaway. You understand? Seaway is a water company. Probably if the water in Nigeria is polluted, you understand? So that's like an environmental issue, right? So if the water is polluted, it's definitely going to affect their profits, because the water they are probably going to be producing would be polluted and people will not want to buy, or probably they won't be able to produce or something like that. Do you understand? So now in this case now, ESG is saying, okay, how is the environment affecting our profits? And the other way again is, how is our own activity to affecting the environment? So ESG is looking at it from two sides, but it's looking at monetary most times, you understand? And that's why you could probably have a little calculation, you understand? Might not like calculation, but you could have something related to calculation. So we're going to be checking, okay, how is the looking at it from the two sides: environment affecting the business, business affecting the environment, in terms of monetary aspect, in terms of money. I hope it's clear. If you have any question, just go to the comment section and drop your question. I'll be there to attend to it. If you have not subscribed, how far now? And like my video, share. This is not easy. All right, so verification too. You can see that this one is not, there's no need to verify who is looking at it, not our business, but this one you need an auditor or someone to verify. Now let's look at IFRS S1 and S2. Now, the IFRS S1 and S2, they are global standards created by ISSB for sustainability reporting to improve what? Comparability, data quality, credibility, and investor confidence. So in this case, now you know, like we said, that the triple bottom line, there's no standard, there's no rule, there's no law. But if you followed me closely, you see that when I was talking about sustainability reporting, that I said that they are guided by some standards, right? So one of the standards is the IFRS S1 and IFRS S2. This was issued by the ISSB. You understand? The ISSB. So, and what are the standards for? Comparability, data quality, credibility. See, once you know IFRS, normal IFRS, and normal IAS, what is the purpose of normal IFRS and normal IAS? Why are they doing that? For comparability. Why are they doing that? For credibility. Why are they doing that for? You understand? So the same way to, so don't sustainability, I don't know anything about it, it's still linked to what you know before. You understand? So to aid comparability. So now they help companies show how ESG issues affect profit. I've explained this now before. Like how, just like the Seaway that I actually explained, the water pollution and all of that. And then not only the company, but they also give information to stakeholders on how the issues impact. So in this case now, the ESG reporting is beneficial to the company and to the stakeholders. So when you're talking about stakeholders, we did not say shareholders or stakeholders. When we're talking about stakeholders, we're talking about the shareholders, we're talking about the community, we're talking about the government, the public, everybody that affects or is affected by the operations of the company. So we're giving information to everybody, and that's why you see that there's a standard. Everybody has a company A, company B, company C. They have to follow a particular standard, because if we're providing information, if we want to know, okay, company A is doing better than company B, how do we know? Oh, based on the standard, this one's profit is low, this one's profit is high, something like that. You understand? So that's how we know. Now, I said, for example, now whether climate change increased costs or reduced profits. So we're checking now, okay, in terms of the environmental issues. Okay, now the climate is changing. So the climate change, did it affect us positively? Did they affect us negatively? Something like that, you understand? Now, IFRS S1 is talking about general sustainability disclosures. So now this one covers all aspects. Remember the three pillars, those three tables: people, planet, and profits. So in this case now, IFRS S1 is saying check everything. Check how the people, that's employee welfare, treating our customers right, how did it impact our profits? Check it. IFRS S1 is saying don't only check that, also check too, how did climate change, how did the environment also impact our profits? We'll check that soon. It's also saying that what, not only that too, also check in terms of profits. So check everything. You understand? So I used to say that I called IFRS S1 amebo. Put your nose in everything. But you see IFRS S2, IFRS S2 now not like stress at all. That one is just about climate related disclosures. That one just focuses on climate alone. That's on the planet alone. I beg, I know if I stress myself. I like IFRS S2 is in for soft life. You understand? So how climate change impacts the business and how the business impacts the environment. You understand? So just like I said, okay, climate change, how does it affect the business? Okay, climate is changing. When we talk about climate change, saying that, okay, for instance now, let's say in June rain is supposed to fall, but instead of rain to fall, it's hot. Let's say in December, summertime is supposed to be all over. The weather is supposed to be cold, right? But in December, the weather is raining. You understand? Rain is not supposed to fall in December. But climate change, that's what I mean by climate change. Like things are unstable. You understand? Things are unstable. The weather is unstable, all of that. So you understand? So how did it affect the business? Did it affect us positively? Did it affect us negatively? So that was IFRS S2 is talking about climate alone. But IFRS S1 over Sabi uncle, over Sabi auntie, is covering everything. Something like that. I'm just trying to joke, but hope you are getting the real gist. So I said something here that when preparing your case study report, you can raise a professional skepticism if you observe that the company did not use global standards. I've mentioned this before. So if you are seeing that the company used triple bottom line, fast, you know that professional skepticism is here. Someone not verify, standard, if I raise a professional skepticism there. So excuse me, IFRS S1 and S2 require companies to disclose information under 4 pillars. So when you're using IFRS S1 and S2, so you have to talk about 4 major things. So that these 4 pillars ensure the company's sustainability reporting is clear, complete, useful, showing how it manages the ESG risk and opportunities and the impact on the business. So what is this talking about? So these 4 pillars, and they're saying that what they are trying to ensure that, okay, but we cover everything. Like, you understand? So the pillars, that these are like things that you must disclose when you're using the standard. It's just like now, for instance, let me relate it back to income statements. Now, for income statement, now you must disclose your revenue, you must disclose your costs, whether direct costs, indirect costs, production costs, overheads. You must disclose it, and you must disclose what your profits. So in this case now, for them to now say, okay, for us to capture the real sustainability issues of a company, they must disclose 4 major things. That's what he's talking about. You must talk about the governance, talk about strategy, talk about risk management, and talk about metrics and targets. So now, what's governance saying? Under IFRS S1 is saying that talk about who manages the ESG. You understand? Talk about the board. Okay, who is in charge of your governance? Who is in charge of your environmental and social performance? Who is the person that prepared this report? Raise up your hand and show us. So when you're writing your sustainability report using IFRS 1, you say, okay, sort of like when you have your cover page. I'm just trying to relate it to things you know before. You have your prepared by, okay, who is the person that prepared it? You understand? So you state it there. IFRS 2, on the other hand, is saying that who is the person that manages climate issues? IFRS 2, that one, soft life, is only climate is talking about. So saying, okay, in terms of climate issues, who is the person? You say, climate issues managed by ABC. Just like you say, prepared by ABC, something like that. You understand? So you talk about that. Strategy. Now, that's what you should explain any plan. What is the strategy you have? What is the environmental and social governance plan you have? What is the impact you have? What is your future? your futuristic plans, what is your current plan, something like that. IFRS S2 on the other hand is saying that what are your plans in terms of climate action? In terms of the climate, what do you plan? Okay, rain is falling in December. Meanwhile, it's supposed to be cold in December. Rain is not supposed to fall, but rain is falling. Okay, what are your plans concerning that? Oh, how do you manage this? How do you manage that? Okay, for instance, if it's an agricultural company now, if there's climate change where weather is supposed to be raining, well, it's sunny, it's going to affect their business. Okay, what are your strategies to manage that situation? Tell us. You have to talk about it then. Then what? Risk management too. How do you intend to manage any risk? You understand? The IFRS 1 is saying all your risk. But IFRS 2 is saying your climate risk, the only ones relating to climate. Now, IFRS 1 concerning metrics and targets is saying that report all your metrics. Your metrics is saying your measurements. You understand? How do you measure people? How do you measure planets? How do you measure profits? Like now, concerning people now, like what I was saying, employee welfare. Is it that the amount of times our employee were happy or were smiling, or our employees rather were smiling, or what? So how do you measure it? For instance, now, if a company says the way we measure employee welfare is the number of times our employees smiled today, that company, people are not serious at all. Which is, there are other things you can manage. That you can check in terms of their salary. Are they paid well? The conditions of work, are they paid? Are they having a good working environment and all of that? So there are other things. So that's why we want to know how you measure. Don't just come and tell us employee welfare 5 million. How did you get that money? Tell us. And FRS 2 is saying that talk about the metrics concerning climate alone. Okay, how do you measure it? What are your targets? What do you hope to achieve? How is it progressing? Talk about all those things. So these are the 4 pillars. So it's saying that when you're reporting using IFRS 1, S1, and S2, these are the things that must be in the report. So it's the same. Just the IFRS 1 is saying cover everything. IFRS 2 is saying talk about climate alone. All right. So now let's now move on. Sustainable finance and equator principles. Now, sustainable finance and responsible investing aims to fund projects and companies that consider environmental, social, and governance factors. So in this case now, what we're saying sustainable finance and responsible investing, saying that in this case now, people are no more just investing in business. Before now, what investors just want to know is the project, is it profitable? It's profitable. How much will I collect? Oh, what's my dividend? Oh, bye bye. It's good. I'm happy. Take my money. Bye bye. Go. No, it's not like that anymore. Now it's not like, okay, yes, project is profitable. Oh, that's good. How about the impact on the environment? Hey, you now start talking. So people are going a step further. Just like we said, sustainability is like it's going a step further. It's beyond profit now. We're not just concerned about profits, but let's say we said beyond profits. They did not say they are not concerned at all about profits. Profits is, that's why I said people profit and the economy, peace and prosperity, right? So we are concerned about profit, but not just profit now. How does it affect other things? So in this case now, we have like green, social, and sustainability bonds, loans linked to sustainability goals. So these are like those kind of finances that you have, you understand? So now one major global, international principle of sustainable finance. Now, there are many principles that people can use to check. Principles are like guidelines. So guidelines are like, okay, now when you want to fund a project, what are the things that you look out for? Look out for this, ask question about this, ask question about that. So there's so many principles. But one of the most popular principles that people use when they want to assess if a project is actually going to protect the environment is equator principle. So equator principle is like a guideline. So let's look at what it is. Equator principles are voluntary principles that guide banks or lenders when financing projects. So equator principles are voluntary principles that guide banks or lenders when financing projects to ensure that they only fund projects that are socially responsible, and environmentally sound. So now in this case now, we're not just like we said, sustainable finance. We're not just funding projects. Oh, is it profitable? Is it MPV? Positive? Like, no, we are going a step further. But then note, is a voluntary principle. It's not like by fire, by force, you must follow it. No. But banks and lenders are now using it. They're now using it to check, okay, what are the guidelines? Oh, have they done A? Have they done B? Have they done C? Okay, yes, good to go. You understand? So those are the guidelines, the principles that banks now use. Now, in practice, better principles work by having banks evaluate projects. So the banks, what they'll do that, they'll check the risk of the project, they'll look at environmental assessments, they'll talk about communities. If they say, this project is going to affect the XYZ community, they can even send some people there to check, how is it affecting you? So they are really taking it personal. It's not just back taking. Then they'll check compliance, covenants in loan agreement. Also monitor the project. It's not like we just giving money across our leg and say, we'll give you money, should be we have done assessment. No, we'll still be checking. So in Nigeria, CBN sustainable banking principles are the national mandatory principles. In this one now, CBN mandated it. It's not like equator principle that are just like the global like voluntary principles. No, in Nigeria we have mandatory principles that banks use when you are lending. So by fire by force, you must check. So while equator principles are voluntary globally, the CBN's sustainable banking principles make lending what? Mandatory. So it's mandatory. So this is the introductory aspect of sustainability. So now, first thing is just do a little recap. So in the first video, please watch that first. Like I said earlier, we talked about sustainability. We said how sustainability covers like issues relating to the planet, issues relating to people, issues relating to peace and prosperity. So in the ICAN case study exam, they could give you a sustainability report and they can ask you to analyze and interpret it. Now, sustainability reports are reports that cover the activities of a company in relation to how its operations affect the environment, how they treat people, or probably how the operations affect the economy and all of that. Now, analyzing sustainability reports, first of all, I want you to have this image in your head. Think of it like a financial statement. Like if you have income statement or statement of financial position, for instance, how do you analyze it? What you do is that you calculate ratios, right? You probably use, for instance, gross profit ratio or gross margin ratio. You say, okay, what's the gross margin and what is the revenue? You divide it to get your answer. When you're done, you move to the body of your report and interpret. Now, think of it in the same way. It's not different from what you know. But in this case now, instead of you assessing an income statement or a statement of financial position, what you're going to be assessing now would be a sustainability report. So the figures, the information that you'll be considering will be information relating to things like environment and the likes, you understand? So have that image of, okay, is definitely what I know before, so that you will not be too like pressured and too tense that, oh, this is a new thing. No, it's still what you know before. So, but it's just like taking a different shape, you understand? So now, when we interpret the sustainability report, we are simply trying to understand how a company is handling its environmental, social, and governance issues. This means checking the facts, looking for risks and opportunities, and deciding if the information is accurate or reliable or unreliable. So in this case, just like I said now, when they say interpret a sustainability report, what they're just basically saying is that you should look at the environmental, social, and governance issues of a company. Okay, how does the activities of a company affect the environment, or how does the environment affect the activities of a company? How does a company affect the society, its employees, its customers, consumers, and what are the issues related to governance? So when they tell you to assess a sustainability report, these are the areas that they want you to look at. And what are they telling you to look at? You look at facts, you look at risk, opportunities, you check for accuracies, reliability, skepticisms. Like I said, it's just what you know. You know about financial data analysis, financial statement analysis. Is the same thing you are doing. But in this case, you are looking at it from the ESG perspective. ESG is environmental, social, and governance, by the way. All right, now, what are the types of information that you may see? So, in a sustainability report, you would most likely have two types of information. You have the qualitative and the quantitative information. Now, what do we mean by this? Quantitative information are basically numbers, you understand? Like, this involves you measuring performance using tools like ratios and all of that. The qualitative information, these are like words and explanations. So how do I mean? Now think of it like if in an income statement. Now, you know, in an income statement you have like the tables, revenue, costs, gross profit, and the likes. Then you have notes to the accounts. It's making sense, right? So now in that case, now we can say that income statement has both quantitative, that's quantitative is numbers, or revenue is 5 million, cost is 10 million, blah blah blah, and it has what qualitative information, that's like notes to the accounts where they tell you the stories of the company, understand? So in the same vein, a sustainability report could also have numbers and also have like stories. But most times people will always say a sustainability report usually have like stories and all of that, but you could have a mixture of both. So ICAN could give you that kind of situation whereby you have to analyze both qualitative and quantitative, or analyze just quantitative, analyze only. It could come in different ways, but I'm just trying to let you know the kind of information that you may see and you may be asked to analyze. Now, there are so many techniques that you can use to actually analyze or interpret sustainability reports, but this analysis, they could be qualitative or quantitative. Like I said earlier, ICAN could give you an information or a sustainability report that would either be stories, filled with stories, or filled with numbers. You understand? So, of course, if you are having a sustainability report that is filled with numbers, that's like quantitative, is number. You understand? You have to do a quantitative analysis. But probably they're asking to analyze something relating to like a story or words or explanation, that kind of thing. And that will be qualitative analysis. So they could ask you to do quantitative. In that case, probably you have to calculate. Or they could ask you to do qualitative analysis. That's in that case, you have to what? Explain, maybe write a story or something. Like for instance, in May 2025 diet, they said something relating to that. They told them to prepare an extract that will be included in the sustainability report. So they gave them some information and all of that. So in that case, now we could call that a qualitative analysis because they didn't calculate anything. They were just writing stories and explanation. So that was a qualitative analysis where you have to like talk about numbers and all of that. So you can see now, you understand? So but it could come that you have to calculate, so you have to prepare yourself very well. Now, let's look at the techniques that were given in the ICAN new study pack. Now, the first one they said was the framework analysis, framework-based analysis. Now, from the first video, I explained to you, and I talked about the triple bottom line, I talked about sustainability reporting and all of that, and I also talked about like standards. So in sustainability as well, when we're dealing with sustainability reports, we also have standards. Just like you have your IAS, you have your IFRS. In this case too, we have standards. So when it could come like, I can't tell you that, okay, you should check if the company follows like a standard. Like they have different standards actually. We have the Global Reporting Initiative, that's the GRI. We have the ISSB standards. All these things are just like IFRS and IAS actually. So they could tell you that, oh, assess if the company is actually following the standard. Like now, for instance, IS2 talks about inventory, and they said inventory should be lower, it should be measured based on lower of cost or net realizable. It should be measured by lower of cost or net realizable value. You understand? Something like that. So these standards also have their own, like, should I say, the way, the guidelines, the principles. You understand? So they could tell you, okay, based on GRI, this particular GRI standard, the company should measure this particular figure based on this or this. Yes, and just like the example I gave for IAS, then you will have to check, oh, no, this company did not do it in the right way. You understand? So you have to talk about it that, oh, in this case now, the company did not follow the GRI standard. So let's just create a picture now. So let's say the GRI says that you should use 2. You understand? Measure it by using number 2. I'm just giving an example. And the company used number 4. The company did not follow the standard because according to the GRI standard says that we should use number 2. But this company used number 4. So something like that, they could give you like that kind of image. That, okay, is the company actually following this particular standard, and they'll ask you to check it. So that's framework-based analysis. So framework-based analysis in summary is a quantitative analysis that basically covers you assessing a sustainability report using the standards like the GRI standard or the ISSB standards to see if they are complying and all of that. Now, data collection and validation, that one is a quantitative analysis as well. So in this case, what you're doing is that they would ask you to check for accuracy of data, they'll ask you to compare, they'll ask you to check for trends, check if the data they are using is valid and all of that. You know, I made mention of it that the reason why they brought about standards was for compliance and comparability as well, because a lot of people were doing a lot of subjective things. But unfortunately, even though there are standards, people are still preparing their sustainability reports the way they want. Like the standards are still like they're still trying to adopt it and trying to improve on it and trying to make people to start using it, you understand, and implementing it to their companies. So in this case, I can't tell you that check their data is accurate, so provide you some information and then you would probably compare and all of that. So that's a possible situation. Another type of analysis is quantitative analysis. So in this case now, you calculate like ratios, trend. In this case, you're doing pure quantitative analysis, just the same way that you would do for a normal financial statement, you understand? So they are doing pure quantitative analysis. They will ask you to do trend, ratios. They can tell you, okay, these are the industry standards. Industry averages are like based on what is obtainable in the industry. This is the percentage. Like let's use financial statement for instance now. Like let's say the company is into fashion, so it's going to be in the fashion industry. So yeah, you can say that the gross margin ratio, the average gross margin ratio for all fashion companies is 5%. You understand? So if you calculate now and you see your company's own is 2%, the company is below the normal average, or if it's like the company's own is 10% or is above the normal average, so they could give you industry average, like what is obtainable in the industry, and they can tell you to compare. You understand? You calculate your own and you compare. I think they did something similar, if I'm not mistaken now, May 2022 diet. I think that was Best Price Fashions Limited. So in that particular case, they gave them industry averages and they asked them to compare. So they could give you that kind of situation. So you calculate your own ratios, you compare, or you just calculate your ratios and talk about them. You understand? And of course, it's not the normal gross margin ratio or return on capital employed. There are specific ratios that are suitable for assessing a sustainability report, of course. Then the ratios as well, you have to learn. It's just like a bank, the ratios are used for a bank. You have capital adequacy ratios and all of that. They're different from the like normal ratios that we use, but it's still the same way you do ratio analysis that you do for this one as well. Then they can also ask you to do qualitative analysis as well. In this case, like I said, just like May 2025 diet, they can tell you that you should talk about the strategies of the company, the policies, talk about stakeholder engagement, talk about different things. So this company, the sustainability strategy they're using, is it good? The strategy they're using to protect the environment, is it good? Something like that. They can tell you to assess it. Then external data integration. So this one is a qualitative analysis. In this case now, they can tell you to compare the performance of the company with particular ratings. It's just like the industry average, like I said now. They can tell you that, okay, the ratings of the company, let's say, the rating is that people are protecting the environment well. So we rate the protection of the environment by 80%. Look, let's say, for instance, now in the fashion industry, the companies that are into fashion, they are protecting the environment. So we rate them 10%. Just like you're scoring over 10. Ratings are like scoring over 10. Think of it like position. Think of it like CGPA, all of that. So now in that case, now they'll say, okay, the average, just like industry average actually, the average ratings of the fashion industry is 10%. So your company now, let's say your company is not like 1%, that's not good. So in this case now, they are comparing the performance of the company with the average. Okay, everybody in the industry, they are actually doing well. So they were rated, let's say they were rated 80%. Let's give a good score. They were rated 80%, you understand? And your company is just 10%. You got this company is not doing well because other people in the industry, they're scoring 80%. We were scoring 10%. You cannot advise them, these are the ways that you can use to improve your ratings and all of that. So that's what external data integration. So you're using external data, you're using what is happening in the external environment, as in the industry. When you're talking about external environment, you're talking about the industry. You understand? So you're using what is happening in the external environment to judge the company, something like that. Do you understand? So then they could also tell you to do, well, can I really tell you to do this? Advanced analytical techniques, that's it. The other one here. They'll tell you to use software, charts, or graphs. They might not necessarily bother you with this in case study, but probably in the real world, they can give you. But that was one of the techniques that were listed in the study packs, and in the study pack rather, and I thought to bring it to you. So they can tell you to use softwares, use graphs and charts. That's another way we can actually assess the sustainability report of a company. Then identifying greenwashing. So greenwashing is just saying that you're exaggerating your achievements. For instance, let's say the company was able to protect the environment by, like, the protection they did was 5% protection. But then they now say they are doing 75% protection. They have exaggerated their achievements by 70% because you are doing 5%, so you are doing 75%. You understand? So exaggerating achievements. And of course, there's a lot of subjectivity when it comes to sustainability reporting, because you cannot really rate or really say put a particular figure to say this is the way I'm protecting the environment, or this is what I'm doing right, or this is what I'm doing wrong. There's a lot of subjectivity around. So many times companies often actually exaggerate achievements. So in this case now, they can tell you that they should check for accuracy. And in this case, I'll be doing what they call professional skepticism. You're checking, this information, is it reliable? Is it accurate? So these are the kind of questions that could come. You understand? So prepare for anything. Now, just like we said, quantitative analysis involves using ratios, using trends. So I actually included some ratios here for you to see some possible ratios that could be used to assess a sustainability report, so you can go over it, learn it and all. And I categorize them into the three pillars. You understand? The environmental, the social, the governance and all. Please, if you have not watched our first video, watch it so you can understand clearly. So I categorize them for you. You can read up, you can learn more. This, I'm not sure this was in ICAN pack, no, but you can learn more, you can read more. Yeah. They talked about ratios in ICAN pack, I remember. Yes, they talked about it. But you can just learn more, you can read more and get more clarity. All right. Now, the principles of analyzing and interpreting sustainability report. So these are like saying, okay, how should you analyze the sustainability report? What should you do? It's just like now when you're doing ratio analysis for income statement or statement of profit or loss or whatever. What you do, okay, you first of all go and calculate your ratios. You interpret. There are steps that you do. There are things that you do before you can actually do ratio analysis and all of that. So in this case now, how can you actually analyze and interpret sustainability report? What are the steps that you should follow? Now, the first one is what you have to understand the company. Now, if, of course, when they release the pricing, you will definitely know the industry that the company is actually operating in. Okay, is it the fashion industry? Is it the hospitality industry? Is it what is the technology? What are they doing? Understand? So your job is to analyze and research, check, okay, what is actually happening in the industry, know about the industry, know about the happenings that are in the industry. For example, I said here, a water bottle company faces different sustainability issues than a tech company. You understand? So the issues that a water bottle company like Ever, all this Nestle and all of that, the issues that they face will be different from a tech company. You understand? So you have to understand, okay, what are the issues that are happening in this kind of industry, so that it will help you when you're interpreting. Then you also want to focus on important issues. There are so many issues. When you start researching, there are so many. And how many do you want to know? So Google, what are the material issues? What are the important issues? What are the most significant issues? Like I said, for a factory, emissions and wastes are more important than office usage, office energy. Like a factory is like the emission is saying that the smoke that they are putting in the atmosphere, the wastes that they're having, of course, those are like more important than office energy. Office energy is like saying the energy they're using in the office. Like, for instance, now you can say office energy is like maybe the lights they're using, the electricity and all of that, fossil fuels and all of that. But in this case now, the emission is more of a problem, you understand. So there's material issues and immaterial. The immaterial is not like they are not issues, but we can still categorize them as secondary. So what are the primary issues? Now then you also want to check the data. Now the information that they are reporting, is it reliable, is it accurate? Because this is actually a very, very big issue is when analyzing sustainability reports, because like I said, there's like subjectivity. Even though standards have come and these standards have tried to ensure comparability and all of that, but that subjectivity cannot just be like, it's still there, because it's difficult to say I did my protection, the way I protected the environment, I did this was the percentage I protected. There's a lot of subjectivity, you understand? So you have to ensure that you always check the information, verify the emissions, verify, okay. And again, another way that they used to sort of put credibility to that information is by carrying out audit. Yes, they actually audit sustainability report. So if you see that an independent external party has audited the report, you can relax a bit. It's this thing I'm just saying, it's the same thing, it's just like professional skepticism as well, and assumptions. You understand when you have like management accounts and you have published financial statements, all of that, you understand? So that management accounts, the reliability level is low, but a published financial statement that has been assessed or reviewed by an independent external party or auditor, that one has some form of credibility. So in this way too, if you are seeing that the sustainability report of the company has not been audited, that's the red flag. So you can talk about that as well. Then you can compare with others. So if they give you industry averages, you understand, you can say, okay, what is this company doing? How is their people in the industry? So you can compare as well. Then you can look at trends over time. You understand? So see if the company is improving or declining. You understand? So if you are seeing that carbon emissions decreased, that means carbon emission is saying that, just think of it like smoke that they are putting in the atmosphere. You understand? So if before it was 50%, now it's now 40%, that's good. The company is doing well. You understand? So you can look at all those things that are happening to see how well the company. So I'm giving you an idea. So if I can give you a sustainability report, these are the things that you can do to actually analyze it. So check for all these things. Then you can check qualitative information too. So if they give you stories, you can check, okay, what are the strategies that this company has? If a company say, we have no strategy, or anybody that is offended by the smoke or the carbon emissions we have, sorry, that one is an ethical issue, unethical business practices. You understand? So check the qualitative information as well. What is the plan the company has and all of that. So then you can also look at the financial aspect of the company, the finances actually. So you can see how the sustainability affects profit or loss. It is that they're carrying on their profits to reduce carbon emissions or something like that. You can advise them that, okay, while this is good to actually reduce carbon emissions, people take care, because you carry on your money. How much will you use to run your business? You understand? So check all those things. So check as well, and also check too that sometimes, like, look at the example I gave, energy saving can actually reduce electricity bills. You understand? So check too that, what they are doing, is it actually impacting their cost and profits? Does it have positive effect? Does it have negative effect? Check all of that. Then be critical and skeptical. Question and check for greenwashing. Any exaggeration, check. You understand? And like I said, if a company claims zero waste, how will you not have waste? You definitely have waste. Even in a home, you have your garbage bins and all of that. So you definitely have waste. So just check if this information is looking like this one is not possible. And as skepticism is subjective. Don't say, my own, is it a good skepticism? Am I questioning well? It's subjective. Just like that's why I said professional skepticism. Not that you just be questioning everything. You have to look at it like a professional and questioning. So this when they give you a sustainability report, these are the things that you should think about that would help you to interpret. All right. Moving on. Now, the standards that guide analyzing and interpreting sustainability. So there are some standards that actually guide you when you're interpreting and analyzing. Like I said, I mentioned some of them in the first class, but let's just look at them here. So now, this, like I said, I've been emphasizing it a lot, that these frameworks help us to compare. They aid comparability, just like IAS and IFRS. IS and IFRS, they help us to compare, you understand? So in this case too, this standard also help us to compare, they help us to trust information, because there's a lot of subjectivity. I'll still keep mentioning it. So it sort of gives us some form of peace of mind, if that's the right word. Okay, this person use standards. Okay, to an extent, I think it will be good, and it helps to make sure that nothing is left out. So in this case now, they'll say, okay, put this, put this, put this, put this, put this. Nothing is left out. You understand? So one of the standards are GRI. You understand? GRI standards. So in this case now, they will tell you to report on all global reporting standards. In this case now, they require the company to report on all aspects of the company. They'll tell you, okay, report on people, report on planets, report on profits, report on everything. Then we have the SASB standards as well. This one, they focus on the financial aspects of the company. Now, in this case now, people, planet, and profits. But in this case now, GRI covers everything. SASB is saying that let's cover only profits. While we are concerned about the others, but these profits we're concerned. Okay, how is sustainability affecting our profits? Okay, now because we're trying to protect the environment, are we making loss? Because we're trying to protect the environment, is our cost increasing? So in this case now, that's what SASB focus on. So if ICAN wants you to use SASB, they will be focusing on checking. Now, the SASB is the Sustainability Accounting Standards Board. Now, this is also a body that actually creates standards that are used to analyze and interpret sustainability reports. So, in this case, now they are saying that they are focusing on issues that affect the finances of the company. You know, GRI is saying that we should cover everything. We should look at all the aspects of sustainability. It's global, it's general. But SASB is saying that let's focus on others, quite all right. But our main target is how sustainability issues affect the profit of the company. You understand? So in this case, now they are focusing on the profits aspects of sustainability. You understand? That's the main target. So if ICAN wants you to do something like that, they will probably give you the finances of the company, probably the costs, the revenue that the company is generating, and the cost they're incurring on trying to protect the environment, probably because they're trying to protect the environment. Let's say, for instance, maybe they buy waste bins, or they do good drainage systems, or I don't know, something like that. So they will just give you the cost of all that, and they will tell you to say, okay, this cost, though, are we benefiting from it? Is it affecting us generally? Something like that. Then integrated reporting. Integrated reporting too is another framework that you can use to assess sustainability reports. In this case now, they are saying that they are looking at how a company creates and preserve value over time. You understand? So they're integrating everything. So it's like over time. You understand? They're not just considering just 1 year. They are checking different years. You understand? They're integrating it like over time. How have you preserved value? Over time, how have you created value? Over time, how have you protected the environment? What is the social aspects? What is the financial aspects? So they are looking at time and time again. You understand? In that case, then Carbon Disclosure Project Act is another way you can actually analyze it as well. So in this case now, this one reports on environmental impacts. You understand? So in this case, we're looking at the impacts. We're looking at carbon emissions. We're looking at impact on water. How is the company affecting the forests? You understand? Are they, for instance, the paper company? Paper is made from wood. So are they just going to the forest and harvesting all the whole trees that we have in the universe? You understand? So we're looking at the carbon disclosure. We're focusing on that. That's carbon disclosure projects. Now the TCFD, that's the Task Force on Climate Related Financial Disclosures. This one, they're saying that you should disclose climate risk. So they are focusing on climate risk. So disclose it, talk about it. In this case, that's what they're focusing on. Then the UN SDGs. So this one, they're now looking at, okay, how does a company align with sustainability? You understand? How does a company align with the SDG goals? In the first class, please watch that video once again if you haven't watched it. We talked about the SDGs and all of that. So they're looking at how the company's activities align with the SDGs. Are they trying to help the world achieve those goals? Are they contributing their own quota? Something like that. Then the ISSB too. This one, they are the ones that developed the IFRS S1 and S2. If you don't know what IFRS S1 and S2 is, go and check the first video. I explained it in detail. So now in this case, now these are the standards that they could give you. You understand? So, but I think, yeah, I think GRI is the most common, and I think IFRS S1 and S2 as well. I think those ones are like, they are very, very common. You understand? So it's very, very high. Like, it's very, very possible that they may give you something relating to that. Now, let me give you tips on how to prepare a report, because now you're new to this, you might not know how to do this. How do you now go about it? The first thing you should know is, what are the needs of the users? That's your requirements. Go and check your requirements very well. What are they asking you to do? What do they want me to achieve in this particular situation? When you understand that, then determine the suitable methodology. Okay, in this case now, is it ratios I will need? Okay, are they saying that I should assess the trend of environmental impact? I should assess the trend of how the cost that the company has incurred on environmental protection? What are they asking me to do? That I said, first of all, understand it. That will help you to determine the most suitable way to tackle the question. Then, when you determine the suitable way, then you go ahead and analyze using that tool. Then, when you're done, interpret, you highlight weaknesses and strengths, you conclude, recommend, and then use charts and graph when necessary. You understand? So you can see that this is just like the same way you do your normal financial data analysis or financial statement analysis. You calculate in the appendix, you go to the body of your report to interpret. Still the same way. Like I said, it's still what you know. Just that this one is taking another shape and form, in the sense that this one is focusing on environmental protection, but still what you know. So don't get worked up and say, I don't know. It's still what you know. Now let's look at the challenges. There are some challenges that are experienced as a result of, like, when you're trying to analyze or interpret reports. You know, all that, because it's not good, it's not going to be easy. But now, what are these challenges? Let's look at them. First of all, companies may report differently even when using the same frameworks. You understand? So now, we have talked about different frameworks. You understand? So let's say two companies are using GRI, the Global Reporting Initiative, that says that we should report all aspects of sustainability. Fine, company A and company B, they will both be using GRI, but the way that they will report is different. That's why I'm saying that although these standards are here to help us to help to improve comparability and all of that, but we're still not there yet. It's a process. Countries are still trying to adopt it and all. So there's still a lot of differences that you may observe from two companies that are using the same framework. That's another challenge. Now, data may be missing, unreliable, or calculated in different ways, because I said it's very difficult for you to say, okay, I protected the environment by 5%. I affected the environment by 10%. It's difficult to actually determine that data. You understand? And so that's why it may be unreliable. And this is why you have to raise your professional skepticism when you're preparing or analyzing the sustainability report of a company, because that particular information is highly, or let's use the word likely, to be unreliable or inaccurate. Then companies may focus on areas they do well, greenwashing, and then ignore the weak areas. Of course, now, if it is that they are affecting, like now, look at what's happening in the Niger Delta. That oil companies are destroying the water, the fishes, and all of that. They will not focus on that. They'll focus on the good one that they are doing. So that can also of course, you're not really saying what you're actually doing. That can affect the whole analysis. Then reports focus on the past, giving little insight into the future. So in this case, they're focusing on what they did. Okay, how about what you're going to do? And that's why they also said that you should assess the strategies of the company. What are your strategies? What do you hope to achieve? Where are we going to? You understand? Then sustainability issues are complex. You understand? It's difficult to connect them with financial results. There's a lot of complexity. Although ISSB standards, that's the IFRS 1 and IFRS S1 and S2. Although the ISSB standard, that's the IFRS S1 and S2, it's actually helping. You understand? But there's still a lot of complexity. Then the ESG ratings are not always accurate. You understand? They may interpret reports differently. So there's a lot of difference. Then the field keeps changing. Analysts keep playing. Like I said, people are still trying to adopt it. People are still trying to jump on the trend. So there's changes. It's dynamic. So this may be the trend today and tomorrow it changes and all of that. Then analyzing reports can take time. It needs special skills. And this is why I believe that if ICAN wants to give you something relating to this, they may not really bother you too much with a lot. I know, you're finally happy, yes. They may not really bother you too much with it because proper analysis and interpretation of a sustainability report requires special skill. It requires like expertise. So they might not really bother you much with too much information. Then the way they can tackle this is that you focus on the most important issues. You check if the report has been verified by an independent party, right? As is there like an independent assurance that will give us some form of trust or some form of the peace of mind, I'll call it now, something like that. You understand that? Okay. And again, if they use the particular framework, okay, let's see how this framework works. Is it reliable? Something like that. So then you can compare with other companies. If this company is saying that we protected the environment by 80%, and other companies are saying 40, 50, how is your own times two of your counterparts? You understand? How is your own times two of the people in your industry? So that can help us too. Then you can question claims. You can raise professional skepticism. Then build skills in sustainability, stay updated, and state any assumptions when necessary. Now, I want to show you a possible requirement. Now, disclaimer, I can't just started including sustainability in their questions. So there's no diet, you understand, per se that you can say, okay, let's use to solve. So I just came up with this question just to help you. So disclaimer, all right. So I just came up with something that might help you like have like clarity on all what we have been saying, and you understand. So this is just to help you. It's not like an exam question. So don't go and print it out and say, yes, Odetayo gave us an exam question. Let's cram it. Please don't do that. It's just to help you like get clarity on all I've been explaining. So sustainability reports are usually prepared as a separate report from the financial statement. Like they can give you like a separate report. It might not necessarily be like, you have something like statement of profit or loss or other comprehensive income. After you do your profit or loss, you have your other comprehensive income underneath. It might not be like that. Sustainability report is usually like a separate statement on its own. Just like statement of financial position is different from cash flow statement, is different from income statement. So sustainability report most likely will be like on its own. So think of it like a report card of the company. So they'll tell you what the company has achieved, the revenue they have generated, the costs they have incurred on different aspects, costs they have incurred on environment, costs they have incurred on profit, costs they have incurred on the social aspects, that's on their employees, on the community, understand? Then the company may attach key SDG ratios or notes to the account alongside. So they could give you some notes to the account as well. It's just like normal financial statement, right? They usually give notes to the account as well. Then you usually get a table or a set of like data. They tell you about the social, the people, planet, and the economy, right? So they'll tell you about the social aspects, the environmental aspects, the profit aspects of the company, and all of that. Now let's look at an example. This example, the name of the company we're going to be using today is Green Co Limited. So we have 2023 and 2024. So you can see that they gave us profits, they gave us people, and they gave us the planet as well. So you can see that this is our profits. This is our profit revenue, right? Then this two now is our environment, understand? That's the planet, that's the environment. Then these ones are the what? Are the people. You know that we have 3 P's. If you don't understand what I'm saying, please go watch the first video, please. We have 3 P's. We have the people, we have the planet, and we have the environment. You understand? People, planet, and profit. People, planet, and profit. People is talking about like the employees, the community. Then planet is talking about the financial aspects of the company. Then let me recap that again. People is talking about employees, community. The planet is talking about the environment, and the profit is talking about the financial aspects of the company. All right, so let's go on. So in this case now, we have all of that. We have everything. So would now start looking at each of them one after the other. Let's clear this out so that we can have our question. All right, so we're good to go. So now in this case, now you can see that they gave us the revenue, they gave us the carbon emissions, energy used, and then everything about the employees, directors, and all of that. So now they can tell you something like this that calculates, just like you have in normal financial statement analysis. They'll say evaluate profitability, liquidity, operational efficiency, long-term solvency, financial strength of a company, blah blah blah. In this case, now they also they can tell you to calculate specific things. Now, if we look at November 2022 diets, I think that was Kudi Microfinance Bank. The ratios they asked them there were different from the normal ratios, because the ratios that you used to assess the financial statement of a bank is different from the one you used to assess a normal company. You understand? So, in this case now, the ratios you used to assess the sustainability report of a company is different from the normal ratios. So you have to go and learn it. In this document earlier, I don't know if you remember, if you're following me closely, I gave you some ratios. It's not limited to this. Go and learn more. But for this class, these are the ratios that we'll be considering. And we also asked to briefly comment on the trend as well. So you know how it works. You have your interpretation. Before you even look at your interpretation, in your appendix section, you have like ratios, formula table, and you calculate, the formula for carbon intensity is the carbon emissions divided by the revenue. So you get that. Then your energy intensity. So you just keep applying the formula. It's just like the normal way you do ratios. You keep applying the formula to get the answer. All right. So when you are done with that, then you start to interpret. In this case now, you can see that carbon intensity, what happened now? We have 3% and we have 2.2%. You understand? 3% and 2.2%. So that's there was a decline. There was a decline. Then carbon intensity, what happened? From 3, it declined as well to 2.32. The employee turnover too, it declined, but the board independence increased. Then the renewable energy ratio was increased as well. So now let's look at how we'll put this into writing. So you have your heading, the review of the environmental, social, and governance performance. So the sustainability performance of Greenco showed an upward trend across the environmental, social, and governance areas. Carbon intensity decreased. You understand? Suggesting that the company is becoming more efficient. Now, carbon intensity is saying that how much carbon is the company releasing to the atmosphere. Think of carbon like smoke. You understand? Smoke from cars and all of that, or smoke from burning and all of that. I know when you're releasing smoke into the atmosphere, you're actually destroying the atmosphere. That's what we call like carbon. You understand? So in that case now, if they're saying that they reduced the smoke, I'm using smoke. Smoke is like the basic word, but I'm just trying to make you understand. So if they say that they reduce the amount of smoke they're releasing in the atmosphere, of course, that's a good one. Yeah, that's good. So that means they're doing well. You understand? So similarly, energy intensity improved by falling from 3 to 2.23. You understand? Indicating that they are doing better efficiency. You understand? Their energy efficiency is better. So that's a good one. Employee turnover decreased. Employee turnover is saying that how much times the employee are leaving and coming back into the company, who left, who came back, like how was the turnover rate. So if they're saying that there's a decrease, that's a good one. You understand? So that shows that they are treating them well. Why are people not going? People are not going because they are happy now, or at least they are okay where they are, right? So governance also strengthened, you understand, because even the board independence increased. So that shows that governance is solid. Then additionally, the company made gradual process with renewable energy as it increased. You understand? So this is just the same way that you do your normal financial statement analysis, that you do this. Then you have your conclusion. They showed positive trend throughout, and then they are improving. And this trend shows a growing commitment to sustainability that can enhance long-term performance, stakeholder trust, and operational efficiency. Then we have recommendations. Continue what you are doing. The carbon emissions, continue to increase them. Continue to adopt strategies or initiatives to reduce them rather. Then they should implement energy saving projects. They should develop employee engagement, maintain the board performance that they have, and increase investment in renewable energy. So this is the possible way that they could give you questions. Like I said, I can just like really asking these questions relating to sustainability. So we don't really have like a proper sketch. So, but I just wanted to just add this to give you clarity that, okay, what can I expect? What are the possible questions that they could ask? How can I prepare? So this is a possible way they could ask you. Now, remember that I spoke about qualitative and quantitative analysis. This one that I just did now is a quantitative analysis, because now if you remember quantitative data analysis, that we said that the quantitative data analysis in this case now will be using things like ratios, trend, and the likes. You understand? So in this case now, what I did now was a quantitative data analysis. So they could ask you to do qualitative. That's in this case now, write stories. Don't calculate anything. Just explain. Just talk about this. Talk about strategies. Or talk about, is the company adopting the proper standards? Are they adopting GRI properly? Or they can tell you that GRI XYZ talks about this. But meanwhile, the company is doing this. Comment on it. Advise us. You understand? All those kind of things. You can check May 2025 diet. They gave an example of something like that. So they can give you qualitative analysis as well. All right, so I guess this is where we'll draw the curtain on sustainability. Today, we're going to be talking about something important. I always ensure that whatever video I'm creating covers things that would help you to succeed in your examination. So of recent, ICAN has started asking adjustments to financial statements. So you will have a full case study question, but before you can calculate anything, you have to adjust the financial statement. So this topic, you can see now, is actually part of the case study syllabus, but most times students don't read that particular chapter because they just feel like, oh, let me read financial statement analysis, data analysis, and models. But this part is quite important, because if, like, at least May 2024 and November 2025 diets now, those are the most recent diets that they tested adjustment. In fact, November 2025 diets was like serious corporate reporting or financial reporting adjustment. So I decided to create this video because they might decide to test this kind of adjustment, and I want you to be ready. All right, so the topic is business reorganization and capital reconstruction. So first of all, before I start and before I say anything, is what you know already. So don't be like, oh, this is a new topic, I never, calm down. It's exactly what you know, okay? So no pressure, no tension, but let's just dive into the video. All right, so now, what is corporate or business restructuring? What does it involve? So when we are saying that a business is reorganizing itself or reconstructing its capital, what are we really talking about? Now, in simple terms, when reorganizing or reconstructing a company, it is all about rebuilding or arranging the company. So you are saying that reorganizing or reconstructing a company is just, when we're talking about that, what we're basically talking about is what we are basically saying, that the company is rebuilding or rearranging itself. That's what it just said, rebuilding or rearranging. So in this case, it could involve something whereby the company is starting from ground. Oh, let's crash or let's scatter everything that we have currently and restart again. Or, okay, we have something now, let's look for a way to rearrange it in such a way. So the capital structure, the structure of the company, could be environment structure. It could be a situation whereby the company already has something and the company just wants to rearrange that particular structure. It could be the management structure of the company, it could be the way their mode of operations are, and it could also be a situation whereby the company is saying, okay, we don't like what we have, we want to scatter everything, we want to dissolve our management structure, want to start from ground or scratch or something like that. So reconstructing basically involves that. So it's either they are reorganizing or they are reconstructing. So when you say something, you are reorganizing something, like it's still the same plan, it's still the same layout you are using, but just that in this case you are just putting, maybe it was L shape before, you're changing it to U shape or something like that. You're just changing the form and the shape. That's reorganizing. But reconstructing is saying we are scattering everything we have to start again. All right, so now in this case, the company may decide to expand its operations or diversify to include other forms of business. For example, a bakery can start selling kitchen appliances. So it could be that, oh, we are into baking now, let's start kitchen appliances. Let's scatter what we have. Let's not do bakery business again. Let's go into kitchen appliance sales business. You understand? And it could also be that, oh, the company just wants to shut down some parts of the business, and or the company wants to change its management structure, like I said earlier, or the company wants to merge. So these are the possible situations that could bring about a reorganizing or a reconstruction of a business. Now, in summary, it involves two things. Now, when you are saying reconstruction or reorganization, is either the company wants to what? The company wants to increase its operations or reduce its operations. So increasing its operations, it could involve something like an expansion, merger, diversification. So in that case, they're increasing their operations. Let's say they were operating in Lagos and Abuja. You know the funny part? Most times you get questions like this, like almost every single diet, questions like this are tested, but you don't just know that that's what they're testing. Now, there's some case study questions that you see that they'll say the company is operating in Lagos and the company wants to open branches in Lagos and in Abuja and Port Harcourt. Like, they do that often. I know that they did that in, was it May 2024 that I'm not sure, Spicy Confectionery, where they said that the company wants to go to, is it Port Harcourt or something? I think even November 2025 diet, they said they wanted to open branches in Abuja, Lagos and Port Harcourt. So now in that case, now that's business expansion, you understand? So that's reorganization and reconstruction, you understand? But you don't know that's why I was telling you before I started that don't be scared that, oh, which topic is this one? I've never it's still what you know. I'm just letting you know that thing that you have been saying, this is what it means, you understand? So it could also be that the company wants to reduce its operations, and it could be a situation whereby the company wants to shut down a business. Maybe they have a branch in Lagos and the branch is not really doing well, so they can say, oh, they want to shut down the Lagos branch, or they can say they want to shut down the Lagos branch and open another one in Abuja. Or let's say they have 4 products that they're selling. They could say that they want to stop selling 2, that they realize that 2 products are let's say not profitable, and they want you to consider. So the kind of question that could come in this case is, now in the aspect of expansion and increasing operation, down they do it often. They will tell you that the company wants to open a branch in so place, assess the decision and advise them. That one they ask it, like it's very, very common to see that kind of question. And the second one is in terms of reducing operations. They could say that the company has 4 products and they currently want to stop selling 1 out of it, or advise us how should we or assess the profitability of this product. Oh, these are the estimated future costs, these are the estimated future inflows from this product. Okay, advise us, is it a good decision to shut it down? Is it a good decision to stop selling it? So can you see that those are possible case study questions? It's not something out of the ordinary. Now, what is the purpose of corporate restructuring? Of course, a company will not just wake up one morning and say, oh, I want to restructure my business or reorganize my business. What are the possible situations that could occur that could make the company say, okay, let's do this. This is our best decision. Now, most times, when a company wants to take a decision in this respect or in this concerning this kind of thing, is when they have a major problem, or when they want to increase profitability or efficiency. So it's not always major problem. Sometimes the reason why, like now, for instance, the example I used whereby a company has 4 products and they want to stop selling 1. So in that case now, why would they want to stop selling one of their products? Of course, they must have seen that it's like this product is not profitable, or this product is affecting the environmental the environment, you understand, or this product is against the culture. It could be something would have happened for them to actually say, a problem will have occurred for them to say that they don't want to do this thing again. Or it could be on the other aspect whereby it's good. Oh wow, if we expand, we have a branch in Lagos now, if we open another branch in Abuja and another one in Port Harcourt, of course it will increase our profitability, to increase our efficiency. So it's not always bad situations that will make us to take this step. Sometimes it's good, and I feel like most of the times in the case study question is only the good side, because you have questions like, oh, the company wants to expand, the company wants to open a new branch, things like that, you understand. So those are the situations. Now, what are the forms of restructuring? What are the ways? Now, we know that the company wants to expand, or it could be that the company wants to reduce its operation. So what are the possible ways they can do this? Now, it could be in terms of their operations, or it could be in terms of financial aspects. So it could be that the company is saying that, oh, we want to restructure, we want to reorganize our operations, the way we operate. And it could also be that the company is saying it's money, that's our issue. We want to change our money, you understand? And even looking at it, in the aspect of the company saying that they want to open a new branch, that's something like operations, you understand? Like now they're operating in Lagos, right? And they want to start operating in Abuja as well, not just Lagos. So that's changing the mode of operations, that's changing the customer base, the target markets, or they want to target Abuja's in residents. You understand? So that could also be seen under operational. And in terms of financial restructuring, also it could also be, oh, want to introduce a new product or something like that. You understand? So now let's look at each of these things one after the other. Operational restructuring. It involves the restructuring of the operations of the business to improve profitability and efficiency. So now in this case now, they're going to give you a situation whereby the company will say they want to restructure their operations because they want to improve profitability, they want to improve efficiency. And just like the example I used now in this case, the company wants to expand its operations, they want to start operating in Abuja, they don't just want to be operating in Lagos alone. So now in that case now, the company would obviously expand or improve its profitability, because let's say they were having 1,000 customers in Lagos. Now they will have an increase in their customer base, because they will also be getting customers from Abuja location as well. You understand? So that is going to improve their operations, that's going to improve their efficiency, it's also going to improve their visibility. You understand? So that's operational restructuring. And now in this case now, sometimes the company may decide that they want to merge with another company. Of course, if you are merging with another company, it will definitely change the operations, because in this case now, let's say it's a situation whereby company A is merging with company B. Now in this case now, the operations will change. Let's say they had 1,000 staff before. Company A has 1,000 staff, company B has 500, now they have 1,500. Let's say company A was operating in Nigeria alone and company B was operating in the UK. Now they are going to be operating in both countries. You understand? So merging would definitely change the operation. You cannot say, except it's acquisition, whereby, okay, you are acquiring the entire company. And you're not saying that after even acquisition most times changes operations, you understand? Because let's say, for instance, let's say a baking company is acquiring a flour production company. You understand? The fact that you acquire the flour production company will definitely change the operations, because now you're not just going to be baking bread, you're going to be producing one of the raw materials, which is flour. You understand? So it's definitely also going to change the operations of the business, and then also selling some parts of the business too. So it could be that the company is saying, oh, we have a branch in Abuja, but it's not really profitable like we thought, we want to sell it off. That will change the operations, because now, let's say they were operating from both locations, Lagos and Abuja, but now we're just operating in Abuja alone, you understand, or Lagos alone, since we have sold the Lagos one. Then stopping unprofitable products as well. So I've given examples, like the example I gave of the company having 4 products and deciding to shut down one, then closing branches that are not profitable as well. So these are the possible situations whereby operational restructuring would be required. Now, what are the possible exam questions? Because now That's the main thing. And like I said, there are things that you have seen over and over again over the course of your ICAN journey, or let's say over and over again in the case study syllabus. Merging, acquiring a company, shutting down a company, or shutting down decisions may involve, want to shut down a branch, want to shut down a product line. You understand? So these are possible questions that you could see, and they test it often. Now, let's look at the second aspect of restructuring. Now, the company may say, okay, our operations are fine. We don't need to change. We don't need to shut down any branch. We don't need to shut down any product line. We're not interested in merging or acquiring, but we have a problem. Or it could, I told that restructuring is not only problematic situations that cause it. It could also be that, we want to improve profitability, but we don't want to shut down our operations. How can we do it? Can we restructure our financial structure? Can we look for a way to change the financial resources we have in that case? Now, financial restructuring is a process of what? Of reorganizing a company's debt, equity, and financial resources to improve efficiency, support growth, and increase value for owners and stakeholders. So in this case now, what we're saying now is that when a company is restructuring or reorganizing, we're saying that the company is changing its equity or debt or financial resources. So let's say the company had ₦1 million debt before, so and 500,000 naira equity. So in this case, company, should we reduce or increase our debt, or maybe should we borrow more money? If they loan more, it will increase their debt. If they pay off their debts, it will reduce their debt. So changing financial restructuring or reorganization is just saying that we're changing our financial resources, the money that we have. And the reason why we'll do this is to improve efficiency, to support growth, to increase value for our people, you understand, our stakeholders. And this process is considered when the company needs more money to meet financial commitments, especially when they do not have enough equity or debt capital, or their suppliers stop giving them credit. So in this case now, why would a company want to do this? Most times is when they need more money, because now, okay, we need more money. Should we borrow more? Should we take more loans, or should we raise more capital? You understand? And another situation is when they stop receiving credits, because now, let's say before, we don't have to pay our suppliers. Immediately we collect the goods, but let's say we have annoyed our suppliers, and then they're saying that, we're not interested in giving you credit anymore. Pay before service. In that case now, we have to look for money to pay, because if we don't get those raw materials from our suppliers, or if we don't get those goods from our suppliers, how would we sell? Our customers will come out and ask us for goods. If you don't have, we'll be having stock out. And stock out will definitely affect us, because there's some shops that you would not bother going to, because you're like, I know they will not have what I want. They don't always have. And it's surprising that the shop actually has that day, but because you have labeled them as not always having, that means I'm just saying that not having goods would definitely affect the company's perception, the way the customers will perceive them, and the patronage that the customers will have. Because why will I walk down the streets when I can walk the other way? It's still the same journey. I don't know if you know what I'm saying. So customers like that would definitely not want to come to their store. So since the suppliers are not giving us the goods on credit anymore, we have to look for a way to get money, so that we can continue to be to have goods in our shop, so that we will not lose our customers. So those situations would definitely require us to restructure the financial situation or resources that we have. Now, financial restructuring involves taking new loans. It could be like, let's take more money, let's borrow more money. Raising more shares. Okay, we have 500,000 naira worth of shares. Now, should we raise more shares? You understand? It could be changing the way the money is shared amongst lenders and owners. Okay, in this case now, we are always paying our ordinary shareholders 50 kobo per share. We don't have money now. It's like we reduce it to 30 kobo per share. You understand? Or we are always paying our lenders bi-monthly. Let's say every 2 months. You understand? We don't have money now. It's like it's 3 months that we're doing, or every 6 months. So
in that situation, we are changing of course, if we are paying our borrowers or our creditors rather, if we are paying our creditors 6 months, before we're paying them every 2 months, but now we're paying them every 6 months. Of course, to change the money that we have, we'll not that money that we're paying, we'll have it, we'll save it. And it could also be that, oh, we're paying our creditors, that's our the people that give us loan, we're paying them every 2 months. Oh, let's reduce that duration, let's pay every month. To definitely change the amount of money that we have. So all these things can occur, all the things that occur can change our financial structure. And reducing the debt or equity capital as well. Now, financial restructuring, there are 3 types of financial restructuring that we could have. We could have capital reorganization, capital reduction, or capital reconstruction. So now, what we're saying here is that when the company is thinking, okay, we know that we need more money, we know that we want to improve profitability, we know that our creditors are not giving us, our suppliers are not giving us credit again. Okay, what way can we restructure our financial resources? There are 3 ways. That's what we say here. They can either reorganize their capital, reduce their capital, or reconstruct their capital. So now let's now break it down and look at it one after the other. The first one is what? Capital reorganization. Now, when a company changes, this is when a company changes one type of share into another type. The company replaces one class of share into another to change shareholders' rights. Now, what are we saying here? We're saying here now that this is when the company will change one class of shares to another class of shares. So classes of shares, we have different types of shares. We have ordinary shares, we have preference shares, we have so many types. You understand? So now in this case, now the company is changing one class of shares to another. It could be that the company is changing the ordinary shareholders to preference shareholders, or preference shareholders to ordinary shareholders, to change their rights. Because you know that the right of a preference shareholder is not the same as an ordinary shareholder, definitely. A company, now I gave an example. A company could have preference shares, but decide to change them into ordinary shares so that the shareholders can now vote and enjoy different rights. Of course, you know that ordinary shareholders can vote. They have more rights than a preference shareholder, but preference shareholders are paid first. So it's a win-win situation, no problem. You can vote, but then we were paid first. So everything has advantages and disadvantages, right? So in this case, the company may say, okay, you people want more power, you want more rights, you want more voting power and all of that. Okay, let us change your shares from ordinary to preference. From preference rather to ordinary. Yes, let's change the shares from preference to ordinary. So this changes their rights from preference to ordinary shares. So now I put a possible case study question. So now I was saying that I know from the beginning of this video I told you that most of the time when they give you situations like reconstructing or reorganizing a capital or a business, in that sense, a business's capital or a business's operation, when that situation occurs in your case study exam, most times usually maybe adjustment. It could be financial statement adjustment, or it could even be a project or a contract the company is considering, or a decision the company is taking. So now when you are dealing with capital reorganization, it usually comes as a financial statement adjustment. So you usually have a financial statement adjustment because in this case now the company is changing ordinary shares to preference shares. So there's some calculations that may come. So now, currently, I give an example. XYZ currently has 10,000 preference shares of 1 naira each. Let's clean this off so that we'll get the question. He has 10,000 preference shares of 1 naira each. The company wants to cancel them, and give the shareholders 10,000 shares of 1 naira each. 10,000 ordinary shares. So now, in this case, now they currently have preference shares of 10,000 preference shares of 1 naira each. Now they want to change that preference shares to ordinary shares. So now what would they do now? The existing ordinary share is 20,000 1 naira each. So currently, this is what it's saying. Currently, the company they could give you this could be an additional information or adjustment. They're telling you now that the company has 20,000 ordinary shares. That's what they have currently. But now they have 10,000 preference shares. So they have 20,000 ordinary, 10,000 preference. Now that preference, now they want to convert that preference shares to ordinary. It makes sense. And now, so now we have a solution. We have existing ordinary shares is 20,000, and you know, if it's saying that 20,000 naira each, that means what the value of the share is going to be 20,000 naira. Now, converting it now, if I'm saying that we are converting 10,000 preference shares to what? We are converting 10,000 preference shares to what? To 10,000 naira ordinary shares. That will be what? 10,000 ordinary shares times 1 naira. That will be what? 10,000 naira. So this means that what? This means that what the preference shares of 10,000 naira will become ordinary shares. Simple. So now in that case, now if we are saying that before conversion, we had 20,000 ordinary share capital, we had 10,000 preference share capital. That means what the total equity was what? 30,000. You understand? That makes sense, right? So now, if they're now saying now that we want to convert, so after conversion now, that means what? The preference share capital will be 0 because we are eliminating the preference shares and adding it to the ordinary shares. So truly, the equity will stay the same. Only the structure will change. The equity will stay the same. So it's not really affect your calculation per se. Do you understand? The only figure that may be affected is your investor ratio. So your ratios like ROCE, debt to equity will still be the same because equity was 30,000, is still 30,000. But in this case now, they will just want to just test your knowledge. So no, there's some additional information, even from corporate reporting and financial reporting, that when you adjust, the figure will still be the same. Like now in this case now, total equity was still 30,000 even after conversion. But they are testing your knowledge of accounting. They don't really know if you understand capital reorganization. You understand? They are just reorganizing capital. I was telling you before, it's just reorganization is you have the same thing. You are just reorganizing. You know, it's just like when you have like your living room. You want to, you say your chairs are arranged in a way like, I don't like the arrangement of my chairs, or I'm tired of this arrangement. I want to rearrange my chairs. Now you are just rearranging the chairs. You're not throwing out the chairs or selling the chairs. You're not selling it. It's still the same chair. You're just changing the way it looks. You understand? So it's still the same 30,000 equity. What you're just doing is that you're changing the class of the equity. It makes sense, right? So your calculations might not change, but the idea behind it is that I want to test if you understand these principles. All right, so but then if you're doing investor ratio to change, because you know you need for instance, earnings per share is your profit after tax and preference dividend divided by number of ordinary shares. Of course, number of ordinary shares will change now, but if you, apart from investor ratios, every other thing will stay the same. All right, so capital reduction is the second type of financial restructuring. So this is the process of reducing the share capital to eliminate accumulated losses and reflect the true value of the company. So accumulated losses are also known as negative retained earnings. So now you know in this case now, you know when you have your SOPL, that's your statement of profit or loss or other comprehensive income, you know that when you have your profit after tax, if there's no dividend though, if there's no dividend, you know your profit after tax will be transferred to equity. That means it will be transferred to retained earnings under equity. Happy? These are just basic accounting, this thing, corporate reporting adjustment. So it's not something I'm saying that is too complex, please. All right, so your profit after tax, if there's no dividend, your profit after tax will be transferred to retained earnings. So now in this case now, if over time, let's say in 2021, the company had net loss. Like instead of net profits, the company had net loss. 2022, the company had net loss. 2023, the company had so the company kept having loss. That means what we will have been transferring loss to the retained earnings account. You understand? So that means what instead of retained earnings, we are going to be having retained loss, because now we have been having loss. And another name for retained earnings and retained loss in that case, or negative retained earnings, is what? Accumulated losses. So whereas what the company has accumulated losses over time. We have accumulated losses. So now in this case, now the company may say, okay, this accumulated losses is not really making our financial statement to be looking fine, because now if we're looking at our share capital account or our equity account, we are seeing loss, the thing is loss. It's not really making our figure looking fine. So now, okay, what can we do? We can eliminate that loss. You understand? We can eliminate the loss using the share capital. So now, because now some people may be like, eliminate the loss. What do you mean by that? You understand? So what happens is that you transfer the losses to share capital accounts, meaning that what the shareholders will accept that loss as part of their investments and as part of the loss of their investment. So now let's say that the value of the share capital was 1 million naira, and over time we'll be having net loss, and now currently, as of 2025, we had accumulated losses of 500,000 naira. So now in that case, now if the shareholders are saying that the value of our investment is 1 million and the loss that the company has made is 500,000, so let's eliminate it. So now we would eliminate the 500,000, we will have 500,000 less. So let me give you an example so you can understand. Let's say I have 1,000 naira. Let's say I have 1,000 naira and I'm walking on the road, and a little boy comes to me and says, "Oh, auntie, I don't know if you have experienced this before. Auntie, please, I sell table water and I lost my money, and my mommy is going to beat me. Please help me." I say, "Okay, how much is the money you lost?" I lost 400 naira. I have 1,000 naira with me, right? And now, what is the loss he has? The loss he has is 400 naira. So what will I do now? I will take out 400 from my 1,000 and give it to him. So now, does he have any loss? No, his loss has been eliminated, because now you have eliminated the loss. But now, do I still have 1,000? I don't have 1,000 again. What I have now is 600 naira. Do you understand? So that's the idea behind capital reduction. The shareholders are saying that the company already has a loss existing, and it's not looking good on us, because if investors are seeing our financial statement, they are seeing loss, it's not going to look good on us. So we have shares now. Now let us eliminate the shares. Let us eliminate the loss using our shares, just like that example of 400 and 600 naira I just gave you. So that's how capital reduction happens, and yes, it is legal and transparent. You understand? It is legal. The company will go to court, the shareholders will go to court, they have legal backing. So a company cannot just wake up one morning and say we want to eliminate our loss so that our financial statement can be good. That one's already creative accounting or fraud. Well, some parts of creative accounting, some people will argue that creative accounting is legal. I don't know about that one. But then this is purely legal. The company will go to court, the company will go to take legal proceedings and all of that, go through legal proceedings and get the legal backing and authority to actually to eliminate. So it's a process. So capital reduction is the process of reducing share capital to eliminate accumulated losses by transferring the losses to shareholders, thereby showing the true position of the company. So now let's have an example. So in the case study exam, they could tell you that, this company has accumulated losses of 50,000 and share capital of 120,000, and the company has received legal approval to eliminate the losses. So now how do you do this now in this case? Now, if they say that the share capital is 120,000 and the losses the accumulated losses is 50,000 naira. That means the company will reduce the share capital by 50,000 naira to eliminate the losses. So now in this case, reducing the share capital account, the share capital account, share capital has a credit balance. So now in this case, now we have 120,000. That's the figure that we have, because it's a capital account, so it's a credit balance. So if we say that we are debiting it with 50, if we say that we're debiting it with 50,000, you understand? That means what will be the value? That means 50,000, and this one will be 70, right? This one will be 120. This one will be 120. Then the balance BD will be 70. The balance BD will be 70. You understand? The balance BD will be 70. So that means what? The actual value of the share capital account is what? Is 70,000 now. That's what it just meaning. We're transferring accumulated losses to it. So we'll close out accumulated losses account and transfer the debt. So now that means what? The shareholders currently have investment worth 70,000. It's no more 120,000. Does that make sense? So that means what? Our share capital will now be 70,000. Accumulated losses account will now be zero. So this shows that the shareholders initially invested 120,000, but 50,000 has been lost due to business losses. So their real investment is 70,000. So now in this case, now your total equity will not change. It's still be the same, because you know that under equity now, let me just show you, because these situations now, they're not really testing, might not change your ratios figure. That's why you hear students say that, oh, I did not do adjustments, I just calculated ratios using what I had and I passed. So it's not like you shouldn't have calculated, but you're just lucky that some of these adjustment, you don't have to, it's not going to change the figure. I don't know if you get it, because you know when you have your equity account, under equity account, you have share capital, you have your sometimes share premium, could be share premium, sometimes you may have your retained earnings. You understand? So this could be all you have, right? So now in this case, now if you are saying that we had loss of 50,000, let me claim that. Let's say we had loss of 50,000 before. You understand? I know it was loss of 50,000. Remember? So okay, let me remove share premium. Let's imagine that it was only share capital and retained earnings that we had. Let's even put the share premium. You know what? Let me clean this off and put it together. I want to just show you why I'm saying that your ratio will not change, but they want to test your knowledge of accounting. So now we said we have equity accounts, we have share capital, share premium, and retained earnings. So now let's say before adjustment, and after adjustment. So now here before adjustment we had 120. So let's say we had 50, let's use 40 here. 40 share premium was 40. And the retained earnings was retained earnings now is accumulated losses actually. So we can say accumulated losses / because now it's accumulated losses 50, right? So this one is 160. 160 minus 50 is 110, right? So now we have said that our share capital is 70. Since we have adjusted now, right? Our share premium is 40. And this one is now 0. Since we have eliminated it, it's still what? 110. Do you get what I'm saying? It's still 110. So it will not change. The figure will not change. When you are doing your ratio analysis, you will still be using 110. But now this has tested your knowledge of accounting. You understand? So that's what it does. And the last one, capital reconstruction. Now this is the process of reorganizing the company's entire financial structure to what? Especially when the company is in serious financial difficulty, to help the company survive and avoid liquidation. It usually involves reducing the share capital, settling debt, and sometimes raising. So it could be reducing or increasing. So we are saying capital reconstruction, it could be in terms of reducing or increasing. You understand? So now it could be that they are trying to reduce their share capital, it could be that they're trying to settle off their debts, that's reduce their loan, and it could be that they're trying to increase as well. So capital reconstruction could be up or down. And now the first type of capital reconstruction is internal reconstruction. So this is where the company reorganizes its finances, but does not close down. So in internal reconstruction is saying that, okay, in this case, let's say we had debt of 1 million naira. Oh, the company say, it's like we hit one jackpot recently and we have debt of 1 million. let's pay off 800,000 out of it. We have plenty money. So now in that case, now they have reorganized their debt finance. So instead of 1 million naira they had before, they now have what, 200,000, because they have paid 800,000, right? So in that case now, they have reorganized their debts. And in this case now, they're not going to close down. They're just reorganizing internally. It could even be in terms of equity as well. So the company continues to exist after the changes. Only its financial structure changes. So they'll continue to exist. They're not closing down. They're not shutting down. They're not necessarily merging or acquiring or selling off anything. They are still the same. Just that they just changed the capital structure. And then in this case, they could reduce their share capital, just like we did now, the accumulated losses that we did. They could rearrange the debts, they could adjust the value of the assets if necessary, and the like. So in this case now, there's possibility that your figures might change. Now, so let's say they had long-term debts. You understand? Let's say they had long-term debts of 1 million. So now they have paid 800,000 naira. So that means what? The long-term debts will be what? Will be 200,000 naira. You understand? So that means your figure for something like, let's say you are doing debts to capital employed, or let's say debts to equity ratio now, because some people use long-term debts as their numerator. You understand? So in this case now, instead of using 1 million, you're using 200,000. You understand? So in this case now, your figure might actually change. And the second one is what? External reconstruction. External reconstruction, this is where the company is in serious financial trouble. Like they have problem, like serious problem, and they cannot pay their debt. So instead of just dragging along, a new company is created. So they will create a new company, and that company will take over the assets, take over the liabilities, and the old company is closed. The new company starts afresh and is run by the same owners or with new investors. So in this case now, internal was saying that we are just reorganizing ourselves. We are trying to reconstruct, but we can still manage ourselves. Yes, there may be trouble, there may be financial difficulty, but we are not changing anything. We're not selling our company. We are still the owners. That's internal reconstruction. But external is when there's like serious trouble, like the company cannot stand on its own anymore. So in this case, now they will probably want to sell off their company. So how can this come in case study? They could give you a situation whereby it could be an acquisition question. They could tell you that the company you are dealing with is ABC, but then they got the proposal from XYZ company to sell their company. So now they're telling our own company to acquire them. So it may not be us having the problem. It could be the company that wants to acquire having the problem. Do you get the gist? So they could tell you that, help us to check. This one that they are saying that they have financial problem. They want external reconstruction. Help us to check. Should we merge or should we acquire? So these are possible case study questions that I've tested over and over again. So that's what I was telling you, that it's not something new or out of the ordinary. It's still what you know, but just I did not know the name to attach to that thing. So they have asked and tested questions like that. I know that May 2023 diets, they tested merger, they tested M&A, merger and acquisition. I think in March 2022 diets, Kudi microfinance as well. There was something about acquisition as well there. So they have tested situations like this before. Even I think May 2024 diets to Spicy Confectionery, they were saying that the company wants to acquire, they have proposal from two companies, Eat Right and Smoothie Chocolatey, and they told us, they gave us the information for both companies and told us to advise them which one they should acquire. So it could be that situation that a company is having serious financial troubles and the company sends your own company or your clients now the proposal for them to acquire and asking you to advise them. You understand? So those are the possible case study questions, and they have tested over time, so it's not something new. So creditors are consulted and they receive assessment through cash or later payments or shares in the new company. The process is legal, organized to rescue, and is a legal and organized way to rescue the business and give it a chance to become profitable again. So this is the chapter, is it chapter 4 or 5? I don't know, on in case study that people neglect, that people don't really read, but that's fine. It's still something, you know, even if you didn't read it or something like that, it was still something that you were aware of. I just thought to elaborate on it and emphasize it, since it's like ICAN is coming up with a trend of a financial statement adjustment. So I just wanted to just learn it so that at least you would know the name and the terms for it, and in case they bring adjustment like that, you would know how to go about it. I hope this video helps. If decided that you were going to read the ICAN case study pack, but when you got to the last 2 chapters, you just skipped because it just looked boring and the pages were so many. Well, you are not alone. And guess what? You don't have to feel guilty anymore because solution is here. Yes, I have summarized the last 2 chapters, and I'll be creating a video. In this video, I'll be sharing one with you, and I'll share the other in another video. So anticipate. Just hit the subscribe button and turn on your notification bell because I'm going to post that one soon as well. All right, let's start the first one, which is chapter 13. So chapter 13 talked about the soft skills for accountants, and guess what? Chapter 13 is about almost 70 pages, and I was able to summarize that in just 3 pages. Wow, such a relief, right? So let's start and let's talk about it. So soft skills for accountants. What did that chapter talk about? Soft skills are important for accountants to grow professionally and to succeed at work. So the essence of all of this, of that particular pack, is to help you to learn the skills that are needed to grow and also succeed in your workplace. And these skills include skills like creativity, leadership, emotional intelligence, negotiation, project management. And accountants are expected to think beyond numbers and develop abilities that help them work with people, solve problems, and make better decisions. So as an accountant, you're not just sitting down there solving questions or preparing financial statements or an financial analysis. No, you are much more than that. Yes, you have to think beyond that, because it's not just about learning corporate reporting, learning about auditing, learning about taxation and the rest of them, but you also have to develop some skills, and that's what we call soft skills for you to actually be successful at work. Now, you must have seen a lot of people that are very intelligent. Like, there's some people that their intelligence is not just on this level again, but they are not successful in their careers, or they get sacked or fired all the time. They don't have a stable job or a stable source of income because of some skills that they don't possess. And that is why this part of the textbook or the study part is important for you to learn. Now, why is this part of the case study syllabus? Why is this part? Like, why do they include soft skills? Because one moment we're doing ratio analysis, another moment we're doing NPV. Where did we get to? Like, what are we doing now? All right, so here's the reason. The purpose of the case study paper is to teach you how to analyze complex issues and make decisions. So what you are basically doing in your case study exam is towards you are learning how to analyze issues, because the truth of the matter is, when you are in a real life situation like a company, you are employed, or even if you own your own company, most of the time, let's just say sometimes you'll be faced with some issues that may be a bit complex, and you have to solve that problem and make decisions, basically. So making decision is beyond calculating. So when you are making decisions, sometimes it's not just about calculating numbers. You have to think. There are some decisions that you will ask you. So let's take an example. Let's have an example. For instance, if you want to make a decision about, let's say, your office space, like the building that you want to set up your office in. Yes, you have to consider the cost of setting up your build of setting up that place, probably the cost of rent and all of that. But it's beyond that. You have to look at location too matters, because if you can open your office inside one corner that nobody comes to, no matter how good you are, some people will not see you, because the purpose of offices sometimes is not just about clients that know you, that you say, yeah, take left, take right. Some people may just walk and say, hey, they have something here, oh, I can patronize them. But if you can't enter corner, nobody will see you. So what I'm just trying to say, essence, is that decisions, some decisions may require you just calculating and making the decision, doing ratios, doing MPV, making the decision. But sometimes the decision you want to make may be beyond you just calculating, is it profitable? There are other things that you may actually consider, qualitative factors. You understand? And then that's why you need soft skills to be able to come up with wise and valuable information that will be useful for decision making. So you see now that you actually need it in case study, because I've gotten that question a lot of times. People be like, why do we need this in case study? It's so boring. What's the essence? Let's calculate ratios and go home. But you need it. You need to understand this thing. So that's why. And me, I believe that when the purpose of a thing is known, abuse is not going to occur, because when you have known why chapter 13 of the case study pack was included in case study. So now that's fine. So now I summarized these skills. There were 12 in total. I summarized them and we're going to talk about them right now. Obviously, the pack was over 60 pages, almost 70 in fact. I didn't cover every single thing, but I covered all the skills and the important points that you need to know about those skills. You understand? So let's look at them. Skill 1. Originality and initiative. So originality is about coming up with unique ideas, while initiative is taking action without being told. So when you're talking about originality, you're basically saying that you want to come up with unique ideas, you want to come up with ideas that haven't been in the market before, something new. But initiative is just saying you're taking action without being told. And then now these skills are very, very important because they show independence and creativity, which customers value. Like, there's some people that you have to just tell them, oh, when you get to the office, go left. When you go left, sit down on your chair. When you sit down on your chair, put on your computer. You have to literally give them a map of what they will do. And the moment something is not on that map, they will not do it. That's very annoying now. If something is employers want is a staff that can think, that can say, oh, my oga is not around. Excuse me, my oga is not around and this particular issue is happening. What can I do? Let me come up with an initiative. Let me come up with an idea. Yes, that's what they want. Not that they're just spoon feeding you all the time. No. So that's a skill that you have to have. And now they involve thinking outside the box, taking risks, staying flexible. You can develop them by trying new things, being open to experiences, and challenging norms. You understand? So originality and initiative is very, very important, especially for decision making. Don't forget where we're coming from. The main reason for case study is for you to learn how to make decisions. And for you to be able to make good decisions, sometimes you have to be initiative. You have to think. You have to come up with innovative ideas. That's the first skill. Let's look at the second one. Creative and critical thinking. Now, creative thinking is the ability to approach problems in new ways and generate fresh ideas. So in this case, when you're working independently, you're taking risks, you are seeing opportunities that others may miss. So you have to be creative as well. You have to think, okay, what can this company need to succeed in this particular area? What are the things that we need to do to be the market leader? So you are thinking, you are generating fresh ideas. Meanwhile, critical thinking creates what? Evaluates ideas. In this one, you are generating what? You are generating ideas. So critical thinking is what? Evaluating ideas to see if they are true, useful, and workable. It works with creative thinking, exactly. So in this case now, creative thinking is what? Generating an idea. So let's say, for instance, you come up with a new idea that my company, I think pink color, the color pink it resonates more with girls. Like girls, when they see something pink, they just fall in love with it. Oh, my company is a pencil company. Why not let's make our pencils pink in color, one for pink, one that will be pink in color, one that will be blue in color. So the boy child will more like, mommy, buy this blue pencil for me. You have come up with an idea. Fine, that idea is not new. I've seen quite a number of blue or pink pencils all over. But let's just imagine that's a new idea. Nobody has brought it before. It's a fresh idea. So critical thinking is not like, oh yeah, let's even evaluate this idea. If we do this pink blueberry, is it workable? Is it useful? Will it really make us get into the minds of these children and then falling in love with our product? So it's not just about coming up with ideas, because let's not like, there's some ideas that when you will make the companies to make a loss. Maybe before the companies will try small, they will making small profits. You will not come up with idea that it just scatters the entire company entirely. So it's not all ideas. Yes, creative thinking is good. But what I'm just trying to say, and we talked about originality and initiative earlier, is good, but it's not all the time that what you come up with makes sense, or what you come up with would help us as a company. So that's why you also have to do critical thinking by analyzing those ideas to see if they are workable. Creative thinking involves critical thinking involves analyzing and judging ideas, while creative thinking is producing them. So two of them must work hand in hand. And obviously, to make good decisions, these two have to be skills. As an accountant, basically, you have to develop these skills. They are very important. Skill 3, integrative thinking. Integrated thinking is about connecting all the factors in decision making to create value. So in this case, now you are connecting all the factors in decision making. You understand? Let's go on. It involves considering the full picture to find creative solutions that work for everyone, and it avoids narrow thinking and helps businesses succeed. So what are we talking about in integrated thinking? Integrated thinking is that you are connecting all the factors, you are considering everything. Like now, for instance, I used to tell my students a lot that when you are making decisions, you don't just look at the financial part alone. Like now, is the business profitable? For instance, let's say the company wants to merge with another company. It's not just, this merger, will it give us money? But what if the merger gives you money, but the company is into cocaine, or the company is into fraud or money laundering or something? Yes, you get money. You were happy that the business is profitable, but you don't know that the money that you are happy about is cocaine money. You understand? So what I'm just trying to say is that when you are making decisions for a company, whether it's your own, whether you are working there, you have to think beyond numbers. You understand? Is it profitable? Yes, it's profitable. Check. But other things, company, you make money, but this company, you know, it's cocaine. Something like that. So that's what we call integrated or integrative thinking. We are considering all the factors in decision making. And trust me, I believe this is one prime skill that as accountant we must develop. Even as a human being, like in your day-to-day life, you must develop it. You cannot, for long-term success in life, you have to consider everything that you are doing. So that's skill 3. Skill 4, persuasion. This involves what? When you are persuading someone, it involves influencing others to think or act in a certain way, using words, logic, or emotions. It works best when you communicate clearly and understand people and build trust. So when you're saying you want to persuade someone, basically you're trying to influence somebody to act in a certain way. And this is very, very important, especially when we're making decisions about how to maybe sell your product to a customer. If you're coming to me, you're just like, Mama, auntie, buy my product now. And that person like, auntie, hey, this product will make you, let's say it's a cream, like a body cream. If you use this product, in 2 days you'll be fresh, all your pimples will go, who will you buy from? Obviously now, you say you'll be like, your mouth's too sweet. Let me buy one. Leave me alone. You understand? So the ability to persuade people is very, very important, especially when you're making decisions. Especially as an accountant, apart from decision making, you have to be able to persuade people. You have to be able to, for instance, if they say, we want to invest, or we have an investor, accountant to help us to do the financial aspect of it and help us to pitch this idea to the investor that wants to invest. But you're coming, even you said you're not even convincing yourself. How will you convince? How will you convince another person? Obviously, you have to be convincing. You understand? You have to be able to convince the person and all of that. So it's very, very important. All right, that's another skill. Another one is what's negotiation. Negotiation is a process where two or more parties reach an agreement by compromising to benefit all. So in this case now, you are negotiating, you are trying to say, okay, how can we come together and meet and make an agreement? Yes, and how can we come together and make an agreement? It occurs in organizations, communities, it occurs everywhere. Understand? So when you're saying you're negotiating, this is also an important skill because you have to learn how to speak to people. Like I said, a company does not exist in isolation. Whether you are a company that sells goods, you are a company that renders services, you will definitely have customers. You understand? You have customers. So the ability to negotiate, the ability to reach an agreement, the ability to say, okay, this will benefit me, this will benefit you, is very, very important. And so as accountants, you must have that skill. And it can occur anywhere. It can be in organizations, communities, can be even in your day-to-day life, like in your family. And there are two types of negotiation. We have the distributive negotiation, and then we have the integrative negotiation. The distributive negotiation and the integrative negotiation. Now, the distributive is like win or lose. And this just the image just came to me as I mentioned. This was that of a market. Like when you go to the market and let's say you want to buy shoe and the seller is saying it's 5,000 naira, like 5,000 naira. No, it's 3,500 I have. And the guy is like, they want me said it's 3,500 I bought it. I just added 1,500 and eventually maybe the guy he needs money. Let's say pay. In that case now he has sort of lost because he sold it at its cost value, so he didn't make any profits. But you won because you have gotten a new pair of shoes. You understand? So in that case now, negotiation can lead to a win or lose situation, or it can lead to a win-win situation. In that case now, let's go back to the example. Let's say the guy actually bought the shoe, the cost value of the shoe was 3,500 and he wants to sell it for 5,000. I say 5,000 is too much. Let me pay 4,500. Oh yeah, pay 4,500. You understand? In that case now, the guy he bought it 3,500 but he sold it 4,500. He has gained 1,000 naira. You were supposed to buy it 5,000, but you bought it at 4,500. So you have saved 500 naira. You have saved 500 naira. So in this case, now, so negotiation can either be win-win or win-lose. Win-lose. Well, lose-lose. I don't know about that one. No. Mediation and arbitration are forms of negotiation. You understand? Are forms of negotiation. So, and in the first one, in mediation, the third party helps the conflicting parties reach an agreement themselves. So in this case, you are meeting an agreement yourself. The person just saying, when you have like therapists will sit down and then the two parties will come together and then they'll sort out their problems. But when you're saying that someone's an arbitrator, like sort of like a lawyer or something like that, the third parties decide the outcome. The third parties want to decide, you people solve this way, you people share it this way. That's why you see that in legal cases, it's the judge that will say, this is my judgment, you understand, this is what I want to do, or you do this, you do that, something like that. So mediation and arbitration, ways of negotiating with people. So mediation encourages collaboration, arbitration is like force, like you must do it, you have no choice, you came to meet me for it. So crying out loud, so you have to follow my way. And these are skills that accountants must have because, like I said, you're trying to help the company make decisions. Sometimes you'll be with a client or the customer, that's if you're the owner of the company, and you have to be able to negotiate. And not all the time will you win. Sometimes the customer will win, you lose, that's distributive, and sometimes both parties will win. But the most important thing is what? Compromising, reaching an agreement. That's what matters. Then another skill is cognitive flexibility. In this case, this is the ability to switch between tasks or think about things simultaneously. It improves learning, problem solving, adaptability, and creative thinking. So in this case now, ability to switch between tasks. You have to, in fact, it's just like even in day-to-day life, basically. Even whether you are a student, whether you are a mom, a mom, you have to open like 17 tabs every 1 minute. New tabs, in addition to the one you have opened before. Or you are a student, you have to think. Because one moment you are in math class, another moment you are in English class, another moment you are in civic education class. So in everyday life, even as accountant as well, you have to have cognitive flexibility. You have to be able to think, switch between tasks, especially when you have to like make decisions on A, make decisions on B, make decisions on C. You have to be able to think. So it's a very, very important skill you have to develop too. Then another one is integrated reporting. This shows how companies create value using 6 capitals. So there are 6 capitals that companies use to create value. So we have the financial capital, manufacturing capital, intellectual capital, human, social, and natural capital. So in this case now, integrated reporting is just saying that how can we create values? Okay, let's bring our money. Of course, if we want to create value, money is number one. You understand? So okay, what products can we manufacture? We need intellectual property too. We need people. We need thinking faculty. The one that cobweb is not there again. Remember the cobweb. We need to think. Human too. We need human force. At least it's not robots. Well, they're trying to build robots that will do that, but at least it's not robots that will come and attend to the customers and all of that. Although some countries already have advanced to that level, you understand. So, and we need to build a social relationship. So, and we need natural capital too. So we have to come together for us to actually be successful, for us to make good decisions. We don't only need money, we need products, we need intellectual property, we need humans, we need good relationship, we need all these things, all these 6 capitals. We need all of them to be able to create value. You understand? So as an accountant, you have to have the skill of integrated reporting. This is how to advise on finances, advise on relationships, how to have intellectual property. All these things are impossible. So it goes beyond finances to include sustainability, governance, and long-term strategy. So that skill is also important. The next one is leadership. Leadership is the process of influencing others to achieve organizational goals effectively and efficiently. So in this case now, you're trying to influence other people. You're trying to ensure that they achieve a goal. It involves understanding yourself, your followers, the situation, and communicating well to motivate and guide action. So in this case now, what you're doing is that you're trying to say, okay, what am I? You have to, because there are some leaders that are very, very harsh. And there are some that are very, very calm. So you have to understand your own modus operandi. Have you heard me say it? Your own mode of operation, because some followers would not like a harsh leader, and some won't mind. You don't care. They'll be like, yes, now he has to be harsh. If it's not harsh, people will do nonsense. Have you heard that thing before? Yes. So there's some people that don't care, like they actually like the fact that their leader is harsh. And people are like, why are you shouting at me? I'm not here, I'm not productive here. So we have these 2 extreme people. So as a leader, you have to understand yourself and know how you would manage group A and group B. You understand? And you have to understand, that's why it's important to also understand your followers too. Understand your followers, and you also have to understand the situation and communicate well. So you understand? So leadership is all about that. I need to see that as an accountant, you have to know these things and be these things, because you would most times find yourself in a place whereby even if you're not the leader of the company or the owner of the company, you may be just asked to head a project or head a department in your office or something like that. So you have to know all these things. These are skills that are important for success. And transformational leaders inspire a vision, they coach their team, they manage change and achieve long-term objectives. So you have to strive to be a transformational leader. And transformational leadership begins with envisioning a clear and inspiring future for the organization. And sometimes they will use tools like all those pastel, all those swords, all those things. So you have to know how to develop a clear vision for the future of the company. I know just like strategic analysis talks about. Strategic analysis is the analysis of the future of the company, right? So in this case too, you have to know how you can implement all these tools to transform your company and make it the best. So this is what leadership is about, and this is a very super important skill that you must have as an accountant. Now, emotional intelligence. Okay. Emotional intelligence is the capacity to understand and manage one's emotions and the emotions of others to improve decision making and interpersonal effectiveness. So emotional intelligence is like in fact all these skills. I've been saying this thing. If you have been following this video, I would say this one is important, but everything is important because when you try to look at it, because I know that people dread chapter 13. Like, do you know what? Let's do something. If you know that you have read chapter 13 from beginning to the end, drop it in the comment section. Like, I want to see like how many people have actually read this chapter 13. So you have read chapter 13, drop it in the comment section. Say yes, I finished chapter 13 from the beginning to the end. Or if you started it and then along the way you just stopped, drop it in the comment section. Or if you are also in the category of I'm on this one, I'm running away, also drop it in the comment section. Let's just interact. All right. So now emotional intelligence too. You have to be able to manage your own emotions. Manage the emotions of others, because for instance, you know the shouting, like the example I said earlier, I used earlier of the harsh leader. That you are just coming how to shout at everybody. That's your own leadership style, and you'll be correcting you, saying that's the way I walk. That's my own leadership style. Now in that case, now if you're that kind of leader, you have to know how you manage your emotion. You know, you say, I have anger issues. No, don't be like that. I have anger issues. Hey, you have anger issues, no problem. What are you doing to solve the problem? Because you have to be emotionally intelligent. For instance, let's say you have a team, and then most of the people on the team, they are group A, where they don't like people to be shouting at them. Excuse me. And you just come now, and out of 5, 3 don't like being shouted at, and you come and you shout at them. Do you think that productivity would be achieved? Some of them will even pull out of the team. How do you want to be effective? How do you want to prosper or make future success, achieve success? So emotional intelligence is very, very important, and there are 5 key components. We have self-awareness. You have to know your own emotion and impact. Like those people that will say, I have anger issues. Okay, no problem. You are self-aware that you, when it comes to anger, you are an anger like this 5 and 6. So be self-aware of your own type, the kind of emotions that you have. Self-regulation to control your emotional responses appropriately. Yes, you have agreed and you are self-aware that you have anger issues, no problem. But you have to be able to control your anger issues appropriately. Know when to unleash and know when to trap that anger inside your body. Don't let it come outside. Motivation is also important. That's driving oneself towards goals and persistence. So you have to be able to, no matter what, even when you're sad, even as an ICAN student, I don't know, it's very, very important. Motivation, because sometimes I just like, who sent me a message? Like, why did I even start this journey in the first place? So you have to like keep motivating yourself, leave your emotions aside, and just keep going. Empathy too, you have to respond to other people's emotions, understand other people's emotions, just like a leader too. And social skills too, how you would build relationship, manage relationship, communicate with people. So you can see that these skills are actually quite important. And emotional intelligence contributes to workplace productivity, stress management, conflict of interest, and high emotional intelligence individuals can navigate complex social situations, foster collaboration, and maintain professional and personal well-being. So if you are someone that actually has like high emotional intelligence, trust me, you will succeed anywhere and everywhere, because you will know when to unleash your terror and your anger. You will know when to calm down. You will know when to motivate people when you self need to be motivated. You know when to show empathy. You know when to. So it's in fact a beautiful skill that everyone should have, whether accountant, non-accountant, everyone should have it. It's important. Now, social thinking. Social thinking is how we interpret or make sense of our own thoughts and feelings and those of others in any situation. So how are you interpreting or making sense of your own thoughts? How are you also thinking of other people? Because it's not just about yourself. You also have to think of other people. You also have to know when to show empathy. It helps us to understand how our actions affect others and guides us to behave in ways that create positive impression. So it's just you thinking and say, making sense of your own thoughts, interpreting your own thoughts. Say, okay, this lady, she's a very soft person. I am angry now. Is it right for me to shout? Or can I just say, oh, can we please have a chat and sit down? You understand? But there's some people that will tell you that, can we please pick up this conversation from when we dropped it later? I'm not really in good mood. I don't want to upset you. You understand? That's social thinking. Yes, you are upset, and yes, social thinking. Some people will be like social thinking will be like someone is doing like smell. No, it's not smell. It's just you interpreting your own thought and saying, I'm angry now. If I had this conversation now, hey, everybody around, don't to 15 kilometers away, they'll hear us from where we are because I'm going to shout. So you have access to yourself, and then you're also thinking of another person too, and people in that situation. So you have to what? It helps you to what? Behave in ways that what will create positive impressions. Because at that point now, like I said, words are like eggs. You understand? As far as I don't shout at you, you cannot come and say I shouted at you. You understand? So people will have positive impression that that guy is so calm. So he's not calm. It's just because he knows how to think. And it helps people feel comfortable around you, builds connections, develop socially based critical thinking. Because there's some people that you will say like, no, it's not gonna be my friend because they are so erratic, like everything please. And some people that you like, well, I like she's so accommodating. It's not because she doesn't get angry, but she just knows how to interpret her own thoughts and think of others. So that's very, very important, even as a human being, anywhere you find yourself in life. Now, business modeling is also the process of what? Showing how a company creates value and delivers that value and captures that same value. So think of it like a blueprint of a company, a blueprint of the company. So when you're talking about business modeling, but basically saying, okay, how can we create value? Deliver this same value to and capture this value in the market. So it's not more like the blueprint of how okay, let's move from point A to point B to point C. And I think one of the models I like very much that helps us with this is value chain analysis. And value chain analysis, I think it was Potter's value chain analysis, yes, I think so. And just helps you at every stage. It helps us know what are the value we're creating, what are the things that we're not doing right, what are the things that we should eliminate, unnecessary things. It's just a beautiful model. Thank you, Potter, for that. You understand? So I'm just saying that my business modeling also involves something like that. So it helps business understand its current state and its future state so that we can make decisions to set goals. Oh, for us to create value, we have to consider A, B, C, D. For us to create value, we have to remove A, B, C, D. So it just helps the company create more value and all. So this skill is also something that as accountants we must have in order to be successful. Then finally, project management. Project management is a structured initiative to achieve specific objectives. You understand? So when I say a project is a structured initiative to achieve special objectives. So when you're saying you're dealing with a project, it's like, oh, we have this goal, we want to achieve this goal because we want to gain this particular thing. You understand? So it's like an initiative that we have, an idea that we have to achieve a particular goal, something like that. So a project manager is responsible for planning, executing, and controlling and completing the project while maintaining quality standards. So as a project manager, you have to be able to plan, you have to be able to execute. So project management is very, very important. And as an accountant, you have to have this skill. If you remember earlier when I mentioned that there's some times that they will put you in leadership positions, even if it's a company, whether it's your company, you could be a leader of a particular department in your company, or you could be asked to head or spearhead a project. Like there's a project in the company and they could ask you to actually be the leader of that particular project team. You understand? So project management skill is important because if how you manage that project and manage the people that are placed in your team matters a lot. The success of that project depends on how well you manage it entirely. You understand? Imagine not mismanaging a project and not doing all the things well, and everybody has created PDF. Oh yeah, come and pitch the idea or to the board, or not say, the PDF was not saved, we have lost everything. You will just be sacked. So managing your project actually involves many things. And project planning is about breaking work in phases and tasks so that you finish the project on time. It moves from planning stage to analysis, design, testing, implementation. So as a project manager, you have to be able to plan your project in such a way that you would achieve that task, but not just only achieving the task, achieving it at the right time. Because if a client says, oh, work on this project for me and I want it done in or completed in 2 weeks, and then you are doing it, but you are doing it well, and the 2 weeks deadline comes up, and then you have not done it yet. Even though you may eventually finish it, but you didn't meet that deadline, so it's going to really, they will not really rate you. They will not rate you again. True, you understand. So project management is very, very important, as well as project planning, so that you can reach your goals. So chapter 13, that has been scary. You're like, how will I do this? That's basically all about that chapter. Obviously, there's some point, maybe like under project management, they will say a lot of things, but this is basically the summary of what that chapter is talking about. And these are things that you should know. So you don't have to be scared again about it. And I was able to relate it to case studies so that you remember you need it and what it's needed for, basically. So if you know that you enjoyed this video or you learned something from this video, please share my video, subscribe, like, and drop your comments. I also want to hear from you. Like, just tell me, you understand, like, have you read this part of the study pack? Have you read it before? Or did you even know that? Did you even know that? There's some people that did not even know that this was part of the pack. So, or have you read it completely? Share your thoughts with me. Today we're going to be looking at chapter 12 of the study pack, which is technology tools for businesses. And this particular part of the study pack is very important, and you're going to see why shortly. And the tools that we're talking about are the digital tools that companies actually make use of for their businesses, their business operations. And we can divide these things into three. We can divide it into the blockchain technology, the artificial intelligence and robotics, and digital communication. So we're going to divide this class into those three segments. So, and this part wasn't as bulky as the chapter 13. I think chapter 13 was about 60 something pages. This was just about 20 or thereabouts. So I was able to summarize it very, very well. So this is going to be a short class, I hope. All right. So blockchain technology is talking about using a shared digital technology, digital record system to store information. So in this case now, we're using a shared digital system. So it's not just a system that, it's just for one person alone. No, it's a shared digital system. We're using it to store information. You understand? So that's what blockchain technology is talking about. And in this case, think of it like building blocks, or think of it like blocks that I used to build a house. You have different blocks. You understand? So, for you to actually have like the overall, or let's create a picture now. Let's say you want to build a fence. I'm not very good at drawing, so just take it like that a bit. So the blocks will be arranged. It will be something like this. So let's say you want to build a fence and you arrange the blocks. You understand? So for you to actually create the entire fence, you have to join all the blocks together. So blockchain technology you can think of it like that. So you are joining different blocks, different information together. You understand why I'm using the example of a fence very shortly. Just follow me. Now, the essence of blockchain technology is to ensure transparency. So this is how it works. Now, we're going to store information together, just like this fence. You see different sources of information and all of that. So, and the reason why we're using all this is that so we can ensure transparency. Everybody can see it. Nobody is hiding. Like when you pass a building, you definitely see the fence. Will the owner use cotton to cover his fence? It's not going. Everybody can see the fence, whether it's the owner or the owner's family or a stranger passing on the road. As far as you pass by a house, you will definitely see the fence of the house. So that's how blockchain is as well. Transparency, everybody can see it. And security is going to be achieved because once data is recorded, it's difficult to alter. Because now, for instance, if I put in this particular block, if I want, can I just, of course, for me to stack up these blocks, I have to use cement. And cement would put everything together. Will I not say, this particular block, I don't need it again, let me remove it. It will scatter everything. And if it scatters everything, somebody will definitely know that, no, somebody was here. So that's the benefit of blockchain, like the security. Once you record data, is difficult to alter. It's not like it's impossible to alter, but if you alter it, everybody will know that somebody was here. Somebody has touched this thing. And then there's a central authority is removed, because there's nobody that is doing Oga or boss. Everybody can see it. You understand? And it removes the need for a middleman. So we don't need somebody to come and be telling us, this. We can see it. Oga, sit down. We can see it. Don't worry. You understand? So that's the good thing about blockchain technology. Now let's look at a relatable example. Imagine that everybody in a class has access to a notebook. If somebody writes, Tolu paid 5,000 to Matthew, everyone will be able to see it and no one can go back and change it without others noticing. That's how blockchain works. Shared, open, and secure. So what are we saying here? It's just like a book that everybody has access to. So once you record something, yes, you can go back and change it. Let's say you write it with Biro. Tolu paid 5,000. When you see, you know that even if you use pencil, if you have you ever seen that? Have you ever noticed that if you use pencil to write something and you erase, you clean it out, you will still know that something was written here previously. So that's how it is. So everybody has access to that source of information or that record. You understand? So it's not something you can just change. It's shared, open, and secure. So businesses use this thing to prevent fraud, to prevent any issue and everything like that. So now let's not look at how it actually really, really works. When a transaction happens, it is recorded digitally. So all these things now, I actually created an image for you to see. So let's look at it now, how it works. So the first thing is what? Tolu paid Matthew 5,000 naira. So that transaction, when it happens, it is recorded. You record it down. Tolu paid Matthew 5,000 naira. It is recorded. Now, afterwards, that information that's recorded is sent to many computers. So you can see now that this is the central place where the information was recorded. So once the information is recorded, Tolu paid Matthew 5,000 naira. The information is sent to different computers, and these computers are called nodes. So we're going to send it to different computers. So look at it. Think of it like how can I put it now? Think of it like a computer room. Once one information is entered on the main computer or the central computer, every other computer gets notified that, oh, something has come up. Now, when that happens, the verification occurs. Yes, that verification occurs and it's automatic. So, and it's not by humans or something. It's the computers. The computers are programmed to check if that information entered is valid. So now Tolu paid Matthew 5,000. Does Tolu have money? Is it Tolu a broke girl? If she's broke, then how did she pay Matthew 5,000 naira? You understand? Is the transaction even valid? Okay, why is Tolu paying Matthew 5,000 naira? Was Tolu owing him 5,000 naira, or the Matthew render a service or pay or sell a product to her? Why is she paying? What's the validity of that transaction? The computers would look at it. Then is it duplicated? Has she paid before? Is she paying again? What's going on? You understand? So the computer will flag out any consistency. Yes, that's the word. You understand? So after the computer receives it, to verify it. Then if all the computers now that we sent it to, said, okay, correct, then the transaction can be approved. Yes, yes, this transaction is a good transaction. No issue with this transaction. And then it is stored in a block. All the transactions are stored in a block, and then it's added to a chain. Now let me go back to this so that you will not be confused. Calm down. Let's take it step by step. I'm like, what are you saying? Omodesola is confusing. Don't worry. So here's how it happens. When let's say I am an accountant in a firm and I enter into the computer or something like that, the central computer of the company. I take it and I enter into it. Tolu paid Matthew 5,000 naira, right? So that transaction I've entered into it. What if it's a lie? What if I'm the one that want to quickly use 5,000 naira to buy shawarma, and I will enter Tolu paid Matthew 5,000, so I can collect 5,000 from the company account and go, it cannot happen like that with blockchain technology. It can't. It's safe, secure, transparent, everything. The computer would confirm. The computer would check that, this truly the Tolu pay Matthew the 5,000 naira, and the computer will also check too that why is Matthew being paid? You understand? Was there a transaction that happened? You understand? Or is it someone that just wants to buy shawarma with the 5,000 naira? So when the computer checks, and how does it say no? I know you'll be like, can computers know? That's why data, you feed the computer with data. There are programs that are run on this computer. So the computer they will have known, the company over time will have been, that's why we call it a blockchain. It's not just one block alone. There are series of blocks. Something must have been, they must have been knowing about Tolu or knowing about Matthew all this while. I don't know if you get what I'm saying. So it's not just something that the computer, how does the computer know? Is the computer excuse me, is the computer a witch? Or is the computer, does the computer have supernatural powers to know that Tolu and Matthew had a transaction or something like that? How can he know? Because it will know, because over time, some transactions have been recorded, some things have been happening. Okay, before it got to the point of payments. I don't know if you get what I'm saying. So once the computer is fed with that information that a payment was made, the computer will go back to confirm if truly that payment is valid and is not duplicated. It will check for different things, you understand? And then when it shows that, oh yes, truly a transaction was made and it's okay, there's accuracy, no problem with it, then it approves it and says, okay, yes, this information is correct. Then you know that, let's say before, we had other transactions about Tolu, about Matthew before. So this one is so that's transaction 1, let's say transaction 2, transaction 3, transaction 4, 5, 6. Some things have been occurring between Matthew and Tolu. So now let's say this is transaction 7, and now this is the 8th transaction that Tolu paid 5,000. So the computer will come and add it. So let's say we didn't have this before. Let's clean out this. So the computer now will come and say, oh, there's an additional transaction. So the computer will come and add the column. I'm coming. You understand what up here with me, Sha? The computer will come and add that rule and say, okay, there's a new addition. So more, if there's another transaction that will cause again to come, transaction 9 to add it. Do you understand? So that's what we call blocks, blockchain. If it's another transaction again, the computer will come and add it. Do you understand? To keep adding. And the beauty of this is that that's why we say that there's a lot of transparency. This is good, because if in the future Tolu and Matthew goes to court, maybe Matthew say, Tolu, you have never paid me money. Tolu will just go and bring out the blockchain and say, come and see. The first transaction that happened on so day, second transaction, Matthew will just be quiet. He will just be quiet, hands down, no problem. You understand? So fraud cannot occur because everything is transparent. And the beauty of it is that both Tolu and Matthew and every other person in the company would have access to it. So Matthew cannot even argue in the first place because he has access to it. He can see it anytime, any day. He can see it, and nobody can just come and change it. Because if Tolu says, that 5K, I don't want to pay Matthew, let me quickly remove it, and now she takes eraser, she comes to clean this one. She has almost scattered everything. If you now come, well, there was a line here before. There was number 5. Where's number 5? Somebody will know that something has gone on there. Somebody was here. You understand? So that's how blockchain works. I hope I was able to break it down for you to understand. So that's what I meant by this particular diagram. When the payment was made, when the information was sent, when the information was verified, and then you can see a block. So it will be, you add everything to the blockchain. So that's what I mean by this. When transaction, how it works, when transaction happens, transaction is sent, the computers use programmed rules to check if it's valid, and then if they agree, then it's approved and it's stored in a block. So I said that, think of a block like it was a page in a notebook. Think of it like a page in a notebook or a batch of transactions. It does not just store one. It will group many verified transactions together. Then that block is what's added to previous. So just like I said, you'll be forming a chain. Yeah, do you understand? So different blocks are added to form a chain. So if you look at this now, this thing looks like a chain, right? It actually does look like a chain. Different things together. So, and there are blocks and all. So that's why I said the illustration of a fence of a house is going to work here. So that's what blockchain is for, and it's very, very good in accounting. And so how does it benefit us in accounting? Why is it in case study? Now, the purpose of a case study exam is for you to help the company make decisions, and there could be a situation whereby they would tell you that the company actually has this blockchain and all, or they want to adopt this blockchain, try to advise them, is it a good decision, is it a bad decision? And blockchain accounting helps faster audits. Like, auditors can easily check if They are seeing that, why did Tolu pay 5,000? This is, oh, they'll go to the blockchain and say, okay, they had a deal before. Oh, Matthew sold some products to her. What's 5,000? That was the five. Oh, so all this is fast. It's easier that way. Not that they'll go and be doing paperwork. You understand? It's faster. Then lower cost as well, like less manual work. You don't really need to hire so many people doing paperwork. The computer just feeds it with the information and then does its work. Then fraud is reduced, obviously. Then it's transparency. Everyone can see. There's a lot of transparency. Everyone can see. Then records are there. Once it's saved, it stays. Like, and although it can be altered, don't get me wrong. But for it to be altered, it has to go through a lot of procedures, approvals, and all of that. So, once it's saved, it's there. So don't even record it at all. If you know you don't want to be caught doing fraud. But once you record it, that's the end. Then smart contract. So payments can happen automatically. So you don't need to say, Tolu verify. That's Matthew. Matthew does not have to be disturbing Tolu. Hello Tolu, have you confirmed? Hello Tolu, have you confirmed? Once Tolu feeds this into the computer automatically, once the computer says yes, this is a good transaction, Matthew can collect his money. There's no need for delay. Then less paperwork, everything is digital, obviously, and it's easy to track transactions. So blockchain is beneficial, not even to the world of accounting, but to humanity. It has saved a lot of things. And blockchain is changing accounting from manual record keeping to automated, secure, transparent systems. So accountants won't just record numbers anymore. They can now focus on analysis and decision making. So we don't have to be disturbing ourselves saying, I remember when I was in school, they'll say you first of all open ledger. After ledger, you do trial balance. After trial balance, we now start doing financial statement. We don't need to do all that anymore. Just give the computer will produce everything for us. Yes, that's the benefit of technology. That's the benefit of technology. So that's what blockchain is about. Then another one we have is artificial intelligence and robotics. Artificial intelligence and robotics. So AI is when computers are programmed to perform tasks that normally human intelligence would require human intelligence, you understand? So in this case now, computers have the capacity. They are fed with intelligence food, intelligence noodles. You understand? So they're able to perform the tasks that humans themselves can perform naturally. We don't really need humans. Although there's a lot of disadvantages to that because redundancy. If I don't need humans again, I can sack you. How am I paying you money when I have a computer that can do your job? Obviously, you understand. So, but AI makes computers smart. It helps the computer learn data over time. So over time, you'll be learning data. Have you ever wondered why sometimes maybe you want to buy a car and you just go on Google and you say, car sellers around me, something like that. And for the next 1 week, once you open your Instagram, you open your Facebook, you open everywhere, you're just seeing car dealers. Because you have fed the information you have fed the computer with data. And what is that data? The data is that I'm looking for car dealers. So everywhere, if the computer actually has AI, it has the artificial intelligence, the computer already knows that my user needs a car dealer. So anywhere car dealers are, it should just be popping up on your timeline. You understand? So AI makes computer smart. It helps us understand the language it helps the computer understand the language of its user. It helps them recognize images, sounds. It predicts outcomes too and decisions, and it helps them solve problems. So machine learning is actually a part of AI that teaches computers to learn that information. So with the use of machine learning, AI can actually learn the data. So that's what helps it to learn the data. So instead of being told that AI computer everywhere I go, please I need car dealers be showing me you don't need to go to Instagram, search for car dealer, go to Facebook, search for car dealer, go to this one, search for car. Once you have fed the computer with it, anyway, it knows what to do. You understand? So it improves automatically as it sees more data. So if tomorrow now I want to buy a house and house sellers around me. So tomorrow, so as you keep feeding it with information, it will keep doing the things you need. It's just like ChatGPT. I don't know if you have observed that in from ChatGPT. If you tell ChatGPT, I am a so person. Even if you're chatting in another chat under that same account, you see that sometimes to refer to that thing that you have said before, you said you haven't forgotten that you have. I gave this information. So yeah, that's why you have to be very, very careful with what you put out there because the internet never forgets and so many things are happening. So just be careful. All right. So types of AI. We have the narrow one and the big one. This one just focuses on one specific task. So in this one, you just like maybe face recognition, Google search, it just focuses on this on particular tasks. Then we have the general or the strong AI. This one can perform so many tasks like humans. Although according to what they said, they're still developing this. We don't have like an AI that is like a human. Yes, it can do many tasks that may require human assistance or something like that, but it can perform any tasks rather. But they wonder, oh, this AI, leave it, Zika. Even ChatGPT as well, they'll keep saying it. I don't know if you have observed that they'll say ChatGPT can make mistakes. So, although humans too can make mistakes, obviously, but they haven't gotten to that level yet, still in progress. Then we have robotics. Robotics is about building machines that can help humans do tasks. So it mixes computer science, engineering, math to make robots that can move, think, and act like humans. So are used in actually dangerous places. They are used in factories, in manufacturing places, and hospitals, so many places. So in this case now, we're building a robot that can actually do human tasks. And there's some robots, although there was one I was watching on Instagram and it wasn't even like the robots were just messing everywhere up. All the tasks that they were telling him to do, it was just doing the other one. You understand? But at least robotics is just saying that okay, let's move from just feeding the computer with intelligence to perform human tasks. Let's actually build a human-like structure and feed it with the intelligence to perform the tasks of humans. So, and in this case now, how does this AI and robotics, how does it relate to accounting? How does it relate to case study and all of that? So, of course, you have to know that if they're saying that computers can now perform so many tasks, that even tells you that as an accountant, you have to keep developing yourself because and if they're saying that robots too can perform human tasks, you understand? And but on the flip side, on the positive side, it's good for accounting. It's good for the world of accounting because now you might not really have to worry about so many things again. Recording is easier. We don't need to be doing all those bookkeeping wahala anymore. We can feed in just like blockchain, like we said now. We can feed the computer with information. Once it records it, it can just give us the information that we need back. So it makes things easier. And even decision making is easier because with information at our fingertips or the power of technology at our fingertips, we can achieve much more. So, and in case study, like I said, the essence of your case study exam is for you to help the company to make decisions, right? So, oh my God, decision making is easier because you can easily use the artificial intelligence to get out information that you need, and then you'll be good to go. So, it's very, very important. Now, the third aspect of technology tools is the digital communication, and this is the third and last aspect. So, digital communication is also used by companies to as technology tools. So this just basically involves you sending information using tools like emails, video calls, websites, instant messaging, and it helps businesses share data, make decisions, and connect to people anywhere in the world. You understand? So digital information is very, very important. So even as accountants, like you may need information from someone that is not in your country or not in the states where you are or in the location where you are. You don't need to send mail like in the olden days. You go to post office and send the letter and then you have to wait months before you get a reply back. And that's definitely will delay decision making because let's say you want to say, should we do A or B? You not have to wait months before something like I just say hello, or you just bring out your phone or your laptop or your tablet and then just send an email or something like that. And if I even get that reply immediately, you understand? So it has really made the world of accounting and humanity as a whole, it has made life easier. So we have tools like instant messaging where you can send pictures, videos in real time. We have emails, we have websites, we have different tools, we have social media. And then the good thing about digital communication is that it's fast, it's cost effective. Like I said, you don't have to wait months. It's cost effective, of course, it's cheaper because instead of taking a bus or something to go all the way to the person that you want to get information from or all the stress and all of that, you can just sit in the comfort of your home and get it. And just like we are now, we are communicating digitally, right? So you don't have to come to my house physically and say, oh, this will teach me about technology tools. You don't have to do all that. At the comfort of your home, you are learning it. So that's the beauty of it. And it's traceable. You understand? And it works across distances, just like we are doing now. But the bad thing about it, the cons are that security risk, you understand, because so many things are out there. You've seen a lot of people get scammed. So there's so many security problems and spams, possible spams too. Then misunderstandings too, especially in terms of maybe instant messaging. Now maybe you send a particular emoji and somebody is misunderstanding, or there's some messages that you read. Sometimes you'll be like, this message is annoying, but the person might have not meant it like that. The person might not be like, can you call me later? And you're like, why is she saying I should call her later? She's saying she cannot pick my call now. She might not even mean it in that bad way. So it really causes a lot of misunderstandings and internet dependency. Like now, even as accountants, like so many people are so dependent on everything. So people cannot even compose an email without saying ChatGPT, is this okay? Like, just do it. Like, so many dependency, like a lot of dependency on the internet infrastructures and all of that. So that's that about digital tools. I know that the pages were many, but basically that's the summary. So I included a possible exam question. So I just thought of something that they could actually ask and how it could come, obviously. So now see, look at the requirement I included here. So they said company A is considering adopting blockchain technology to record its financial transactions automatically. So in this case now, I'm just creating a scenario whereby they'll tell you that the company that you are analyzing is considering adopting blockchain. Like they didn't have blockchain before, but they're not saying, oh, I think we can actually use this to record our transactions. It's more transparent, it's easier, and there's a lot of security there. Then I think that the company is not doing this because they expect that to reduce fraud and errors. Advise us on the benefit and challenges. Now, this is a theory requirement. They're not saying calculate A, B, C, or D. It's a theory-based requirement. So I have a video on theory-based requirements. I'll put the link to that video in the description of this particular video, or you can just check my channel out. You can watch the video, although the link is actually in the description of this video. You can just check that out. Now, theory-based requirements, most times when they give you a question like this, in the pre-scene or in the on-scene, they could have included an exhibit that actually talks about blockchain. So you just basically go to the exhibit and extract the information that you need to answer the question. But the truth of the matter is, if they have actually included a chapter that talks about blockchain in your case study pack, even if they don't include anything about blockchain in your pre-scene or on-scene or any exhibit, you should know, because that's why they have actually included it in the study pack. You understand? And that's the benefit of a video like this. And that's why you should share this video with everyone that you know who benefits from it. You understand? And before I even show you my answers, I want to ask you, based on what we have discussed so far, what do you think is, like, just mention one benefit of blockchain to you. There's no right or wrong answer here, just your personal view. One benefit of blockchain and one challenge that you think that blockchain can actually cause. So before I show you my answer, go to the comment section right now and drop one benefit and one challenge. Let's interact. Let me just want to hear what you say. All right, so let's look at the answer. Now, so how to include it in your report? So you have a heading. And the heading, I just included any heading. You don't have to do this particular one, but since the question talked about the benefit and challenges, I just said the benefit and challenges of adopting blockchain. Then you can have a little introduction here. Blockchain technology is a decentralized digital ledger that recognizes transactions, timestamps. So just like have like a little heading. Then I started talking about the benefits. So I listed about 5 benefits of blockchain, and I explained it small. Then this is the body, right? Then the second part of it all, I actually talked about some of the challenges that blockchain could pose, like implementation, system integration, trying to integrate it into your business, and then regulatory compliance too. And I think that challenge would also be training. Because if you are bringing in a new form of technology, you have to train your staff, and it could be costly. You understand? Like you could spend a lot of money and even time, because before they can actually understand the process may take a while. You understand? I feel like maybe that can fall under system integration as well too. So I just listed some of the benefits. I listed some of the challenges. Then you can have a conclusion as well.
So we talk about it. While it offers some benefits, the other challenges cannot be ignored as well. And then just give some recommendations. Adopt it to prevent fraud, enhance transparency through the implementation of blockchain, uh, provide staff training, and then comply with regulatory standards. So that those are just some of the recommendations I gave. So this is how you can probably answer a possible question on technology tools for businesses. So I just created a scenario, and so that you can see this is just a hypothetical question. It's not from any particular ICAN exam. It's just a hypothetical question. But this is a very possible requirement. All right. So that's all about technology tools for businesses.